we don't really know where the world is gonna go. But now everybody knows that you can't stop for too long, got to keep. But now everybody knows, got to keep.
You don't have to be retired to receive tax-free income. The problem is the vehicles that we've been conditioned to believe to help get us there were never designed to produce income.
Got to keep going. What you want to be, going, you will see.
Oh, yes.
It's your destiny, be in harmony. We were never meant to be apart. What you want to be, going, you will see. You can have everything you want. It's your destiny, be in harmony. Ooh.
If you had a machine in your garage and all you had to do was put a quarter in it and it printed out $100, put a quarter in it, printed out $100, would you ever stop that machine from running?
I know everybody knows.
So what if you use that job that you hate as leverage to fill your machine so they can create income for you, so you don't have to worry about income?
You know where the world is gonna go. I know everybody knows that you can't stop for too long. Got to keep going.
Welcome back. We hope you had a wonderful holiday weekend, a nice break, time with family, time to rest, time to reflect. Maybe you were going through some of the resources. Maybe you're watching some of the replays. Maybe you were asking yourself, what would an extra $40,000 every single year do for me, especially if I didn't even have to work for it? Just having access to $40,000 extra dollars every single year, what kind of what kind of difference would that make in your life right now? Maybe that's the questions that you were sitting for the last week asking yourself. And I really wish Angelique and Donnell would tell me exactly what the difference is and how to unlock that. The secret is in the vehicle that you choose and how that's structured and why it performs differently than others and which one would yield more in income every single year just simply because it's structured differently. That's what we're going over tonight. So you're in luck.
Well done. Well done. So and what it boils down to is we've covered this over the last few lives related to safe withdrawal rates. And so last week we covered the difference between the fee structure of a 401k compared to a secure compound interest account. And today we just wanted to close this out by comparing very similar vehicles. In addition, there's a lot of, I'll call it, excitement around this vehicle and how it's structured and what it can do for you and all of those things. And so what we wanted to do is compare an IUL with an MPI related strategy or a premium finance strategy. Compare those two, because there's if we were to look at these things in quarters or in moments of time, there was this excitement around infinite banking and whole life policies. I'm really not seeing a whole lot of that on my timeline.
Right.
But what I am seeing is a whole lot of people talking about properly structured IULs and what a properly structured IUL could do for you. And what we've been kind of talking through over these last few weeks are, okay, the vehicle is great. The vehicle can produce net worth for you. But what does that mean as it relates to income? When you kind of break it all down, what does that mean as far as money in my pocket? Like, it's possible for you to have more money in your 401k than a premium finance strategy. But when you look at the difference in income, it's night and day. Like, it's 2 to 3 times different. And so what we want to just highlight is kind of close this series out with kind of breaking down the difference between an index universal life insurance policy and a premium finance strategy, also known as MPI.
Yeah. Well, I'm excited. So I loving to see some of the people we haven't seen in a while. LaDon, welcome back. Yeah. That's our new intro. It's a vibe, right? Gets us hype before we get in here and get back to it. Oh, did you just put one up?
I haven't.
I think, okay. I hit a button and another button got hit. Okay, well, anyway, thank you all for being here. And I hope that if you have any questions, make sure to put them in the chat, put a Q in front of those so we can identify them. That way we can address them as we go along. I think there's nothing else really to do but get into it.
Yep, sounds good. And I know we've got a video to share as well. I'll kind of let you know when I think we can throw that up. But we can just I want to just do a quick recap and then we can kind of jump into the video. But I'll let you know.
Okay, all right. Well, let's
Okay,
get into it.
let's do it. So, and you had asked me a question earlier today, and it's really been playing over and over in my head is why should someone care about this? So we've been covering safe withdrawal rate. Why should someone care about this? Why should this be
Yeah,
on anyone's radar? And I think
yeah,
that's a very, very important and question to ask because you would think that I'm just talking about retirement. So if you are, let's call it, my son's age, what, 23, almost 24, or is he 24 yet? I don't even know.
yeah.
Um, but if we were to just put him in perspective, like when he hears the word retirement, like why should he care about something like this? Because retirement seems so far away. So, and I think it's my fault for continuously using the word retirement because I don't mean to. What I am talking about is income and a vehicle that you're putting money into, a machine that you're putting money into in hopes that at some point this vehicle is going to produce income for you. Well, what are those vehicles that we have been conditioned to believe are going to save us when we can no longer work? There's Social Security, there's IRAs, 401ks, 403bs, there's pensions, there's all of these different vehicles. And no one ever sits us down and says, hey, these vehicles, although they may or may not be great for you, the real piece that you want to pay attention to is how much income these vehicles are going to produce. So why
Right,
should I care about this? Because at the root of it all, this is about income. This is about how much income you can or cannot receive from this vehicle when you are prepared to. And if you are someone my son's age, 24 years old, um, this is not having to wait till 65 before you can touch your money. Although some of the vehicles we've been conditioned to believe that we're supposed to be putting our money in won't allow us to. But there are other vehicles out there that, if you do this right, we're talking, you want to retire at 35, you want to retire at 41, you want to retire at 42. And when I say retire, I'm talking you want to stop what you're doing today being, I'll call it a servant to whatever this industry is that you're in, and you want to now go fulfill your purpose and take on some other action and do what you want to do with whomever you want to do it. Like this is what I'm talking about, putting yourself in a position so that you can fire your job if you want to, or put your job in a position so that, you know what, you don't dictate when I will or won't stop working here. I actually get to dictate that. And so it's a different position to take, different control that you have over this W-2 job that you have as well. So why should you listen to this? Mainly because there are these vehicles out here that you may or may be putting your money into that you don't realize that they may not be serving you the way you think they are in the future. And so today we wanted to, again, just close this out as it relates to safe withdrawal rate. What is the safe withdrawal rate? Well, the safe withdrawal rate is the amount of money that you're able to take when it's time for you to start receiving income in retirement, whether that's 59 and a half, earlier or later, doesn't matter. The safe withdrawal rate is the amount of money you can receive out of that vehicle so that you don't run out of money. Because what we don't want to do is fire our job and then realize, oops, I don't have enough to sustain my lifestyle. So now I have to go back to work, or I have to take a job that maybe I wasn't expecting to have to take because I left this other position assuming I had enough. And that was kind of that fired conversation that we were having. People retiring early and then running out of money or realizing they can't sustain their lifestyle as a result. So today we just wanted to highlight two vehicles, the IUL and a secure compound interest account, premium finance strategy, also known as MPI. The safe withdrawal rates are similar, but they're not the same in no way, shape, or form. I'd say on average, the safe withdrawal rate inside of an IUL is somewhere between 8 and 9%. And the safe withdrawal rate for a premium finance strategy is somewhere around that 10, 11. I've seen as high as 15 in some cases. So we just wanted to highlight the difference between these two. And why are they so different? What is it about these two vehicles that makes them so different? Well, in order to understand that, we have to first understand what is an IUL. How does an IUL function? And then compare that to the difference between an IUL and a strategy, a premium finance strategy like MPI. What is it about it? What is it about those two things, two vehicles rather, IUL, Index Universal Life Insurance Policy, and an MPI plan? So what we wanted to do was just play a short video as it relates to an IUL. And I think this lady does a pretty decent job of breaking down how an IUL functions and even gives an example of what the dollar amount inside of an IUL will do. And what I want to do is compare a premium finance strategy to what she's going to highlight in this vehicle. So, sweetheart, if you don't mind, would you mind playing that video for me?
We're going to be talking about how does an IUL grow. First, let's talk about the 3 ways our money grows. First way is fixed. That's like our traditional bank account. Our money doesn't really grow and we're not really losing money as well. Also with fixed accounts though, we're probably getting a 0.01 or a 0.05% rate of return. Then there's variable. It's going to be like your 401k. It follows the stock market. So when stocks go up, your money goes up, and when stocks go down, you also participate in the loss. And there's the index way your money can grow. This is the IUL. When stocks go up, your money goes up, but when stocks go down, you don't participate in the loss, you are locked in your gains. Now we're going to look at an example of a 35-year-old utilizing their IUL for retirement. They're going to fund $800 a month up to age 67 and then stop funding. Starting death benefit, $250,000. Year 1, doing the $800 a month, which is around $9,600 annually, starting death benefit, $250,000. Only funding up to age 67. So far, they've put in $307,000 and they have cash value of $816,000. Even though no longer funding, IUL continues to grow. Also keeping in mind, this is a tax and penalty-free retirement. If you want to know your IUL options, click the link in my bio. Today, we're going to be talking about...
Click the link in my bio.
Click the link in my bio.
So,
Well, I
go ahead.
think that she's very engaging in how she explains that, and I think the baseline of a lot of the people who are out here educating in the personal finance space is that they truly do understand that there's a problem and there's a huge deficit. And as they're learning too, they're jumping out to help other people, each one teach one. And it
Right.
seems like that. We'd say this all the time. A lot of the majority of people really do have in their mind the intention to help, and the belief that they have is sincere that the tools or the things that they're teaching out there are true, right? A lot of the people, though, the things that they're teaching, they don't have experience with because they can't yet participate in some of these vehicles, right? Or they have not seen, participated long enough to be able to understand their own experience inside of some of these vehicles. I wanted to bring this up because the idea behind all of this, especially a lot of people who are jumping into the life insurance industry, we'll say, the idea is still based on income. How can I make the boat go faster? Essentially, is the equation that everyone is trying to compute so that they can create secure income that they don't have to work for anymore, right? And that's really the point of it. It's not I want to do something so that I can stop working when I'm 65. It's like, well, if I have to go to 65 and that is the point where I can quit, then okay. But if there's something were to happen in the meantime, or I just burn out, it could be that you just, it's something family related. Maybe it has nothing to do with you. Maybe your family needs you and that's just where you are. Some people don't get the choice, right? So there's that. But the other part is we have insurance for everything else that says that this is going to be okay. This is going to be stable in the event that something happens, but we don't have that for our income. And essentially retirement income is our way of insuring our income ourselves, but it's really not though, right? And so that's where some of these cash value life insurance policy strategies come into play, because it really is like income insurance, right? In a sense. Right. However, there's layers to this. And so that's what you're going to peel back today is some of those layers. We've done many different live streams on these particular topics, but is it, watching some of these videos is one, it could be very concerning, right? But two, I think I just, instead of picking people apart, because I really do like the way that she delivered that information and I like her glasses, but the baseline I think is that regardless of how much information you have access to, the goal is to help people. The goal, everybody has that goal and everybody should have that goal. There are many ways to 10 and there are some ways that get there faster, right? 5 plus 5 is going to get there a whole lot faster than 2 plus 2 plus 2 plus 2 plus 2, right? So if you are looking for how can I get 2 plus 8 or 1 plus 9, or how can I get bigger numbers factored in here so that I can get to 10 faster, then that's what our goal is, and to understand why these things function so that you understand and can identify the opportunities available to you as they come along. So that's our goal here. We'll go back to the vibe board. Is there anything else you wanted to add before we go?
So no, so I think you can move me back over to the vibe board. I want to just kind of restate what was already stated as it relates to the video, though, because
Okay.
these are the numbers that we're going to go over. And matter of fact, jump on in here. Where is it at? There it is. So a couple things that I want to do
Oh,
is,
hold on.
oh, yep.
There you go.
Yep. And I'm not expecting anyone to be able to read any of this, but I just want to highlight what it is I'm going to cover. So we're talking about a 35-year-old putting away $800 a month, which is $9,600 a year inside of an IUL. And what she basically mentioned was, hey, at the end of at age 67, when he stops contributing into that IUL, he has a cumulative dollar amount of about $307,000 sitting in the vehicle. And then as far as cash value, total amount of cash value, meaning he contributed in total about $307,000. Total amount of cash value in that vehicle is sitting right around $816,000, and it continues to compound from there. So I will get into the details of what that looks like, but the piece that I want to highlight is based off what you heard her say, based off what you heard from her. It sounds like a pretty awesome vehicle. And why wouldn't I want that? Like, what is it about a premium finance strategy that would be any different? Well, a premium finance strategy is a little bit different, it has one factor that's different in between what you saw in this video and what a premium finance strategy would actually offer. And I just want to kind of break down what that is. But I wanted to start here. What MPI is, what a premium finance strategy is, it's a life insurance product that is designed to produce retirement income. It's a little bit different than a life insurance based product that's designed to allow you to do infinite banking, that's allowed you to be able to leverage and do other things outside of the policy. Now, this is capable of doing that too, but the main focus, the main objective here is income. And what's awesome about a vehicle like an IUL or a premium finance strategy is that income can happen at any age. This is not based off some factor or some points that you've accumulated inside some job. It's when you are ready. And the key factors that makes this possible is structure. And it's this structure that matters. So in the vehicle that she was mentioning in this video, and she was talking about an IUL, and I was kind of doing the math for you to understand, hey, is this a properly designed IUL? And it absolutely is. And so there are certain factors that are required in order to have a properly designed IUL. The first one is it has to be max funded, meaning we have to be purchasing the least amount of life insurance legally possible. So going back to our factors, 35-year-old putting in $800 a month for a policy worth $250,000. That is a max funded policy because we're purchasing the least amount of life insurance legally possible, so that the majority of the premium that she's putting into this policy is actually building for. So it's awesome. So it is absolutely a max funded policy. It has to be an option B policy. Option B is saying, as I contribute into this policy, the death benefit continues to increase. Option B is saying, as I contribute, there's a certain portion of my premium that's going towards cash value. And cash value is the dollar amount that I'm able to use, leverage as income when I'm ready. And in addition, the death benefit, which is two numbers, the death benefit is the life insurance plus the cash value. So as I contribute my $800 a month, the death benefit continues to increase, which means the amount of life insurance that I purchased, $250,000, plus the amount of that dollar amount that I'm contributing to this policy added together equals the death benefit, and it continues to rise as I contribute. So a properly designed product has to be an option B policy, and it's the vehicle that we're using. That video was about an IUL, an index universal life insurance policy. But why? Why is she using an IUL and not some other vehicle? Why is there a push to use an IUL versus a whole life policy? And it is mainly because of the factor that is so important to me personally. At my age, I do not have time for losses. At my age, I do not have time for us to change presidents in November or not change presidents in November and then the market not perform. I don't have time for loss. And so the best thing you can do to prepare yourself for whatever retirement looks like, whatever for supplemental income looks like, whatever the vehicle is, whatever the time frame, the best thing you can do is protect the money that you have. And an IUL has a unique feature. That unique feature is called a 0% floor. What that 0% floor allows for, and it's a guarantee. You won't hear me mention many guarantees throughout any of our live streams. But there is one guarantee that is a fact that is provided to you by the life insurance company. It's not something that I guarantee. It's not something that the guy who created or created the premium finance strategy guarantees. It's the life insurance company themselves. IULs have a unique feature called a 0% floor, which means there is a contractual guarantee that the money you put into this product cannot be lost due to market risk. And to put that in perspective, imagine your company's retirement account, your 401k, 403b, TSP, government 457 plan. Imagine any of those vehicles with a guarantee that said, regardless of who's president, regardless of what happens with inflation, regardless of what happens in the market, whether the market does well or not, you can't lose the money that you already made. So you can't lose the money you've put in it, nor can you lose the growth that you've made from that money that you've put in it due to market risk. That is an awesome tool to be able to secure your money. So it's about security. The reason an IUL is used is solely for security. So in the video you watched, she talked about $800 a month for a $250,000 policy compounding over time from age 35 to age 67. She was talking about a max funded option B IUL. The piece that this vehicle does not have is the leverage part. So the easiest way to describe the leverage inside of a vehicle like this is other people's money using OPM. Or another way of framing it would be if you've ever had a retirement account from a W-2 employer. Most retirement accounts or most companies offer a match in their company retirement account. So imagine a match added to this product. So if the video you watched was not only a max funded option B IUL, but it also had a match, meaning the amount you put in, the amount you contributed over time, there was a dollar amount added to that amount that allowed your money to grow faster. That's what we're going to walk through today is the difference between the video you watch and the numbers that were identified in that video and what it would look like if you had a match associated with it as well. So the question you should be asking is, why would I want one versus the other? What is it about one what is it about one versus the other that would want or that would require me to want? Meaning, what is it about this vehicle that, hey, it makes it make sense? And at the end of the day, it's about structure and leverage. You structure it properly. You leverage other people's money to be able to grow it faster. You're able to produce more income at a rate greater than that of your traditional retirement accounts, your traditional IRAs, 401ks, 403bs, TSPs, you name it. This vehicle allows you to produce income faster. And it doesn't matter your age, meaning you're not, I'll call it limited by what the company states you have to be, the age that you have to be, or the points you've accumulated based off your time with the company to be able to take your income, meaning it's void of age. It's just simply based off time. The more money you provide, the more time you give your money to compound, the more income is generated. The more income generated, the more income you're able to take. And that income can be received at any point, regardless of age. It's pretty powerful. So what we want to highlight is the differences between the two using these four features, which is a max funded option B IUL with leverage. And so to understand that, I want to just kind of walk through this picture a little bit. So the structure of an IUL is based off, again, a max funded option B IUL. So you're putting your contributions on a monthly basis, $800 into this vehicle. So where is it actually going? Well, it's actually going into a bucket. So picture this as a bucket. And At some point, starting in year 3, this bucket is going to have more than $1 amount in it. So it starts out with your contributions. But at year 3, there's an additional match or contribution that's going to be added in this bucket. This bucket is where that 0% floor lives, meaning this bucket is where the contributions you've put in it, there's a contractual guarantee that says you can't lose the money inside of this bucket. And then what ends up happening is you have $2 amounts working for you at the same time. Sweetheart, did you have a question?
No, it's we had a comment that I thought was probably good at the time, and it was Tom was saying like I never really understand the option B part.
Yep.
But he follows just about everything else, but the option B throws him off a little bit.
So let's give an example. Let's provide an example. So let me go back. So if we're talking about option A versus option B, meaning option B is not a term that I came up with. Option B is a life insurance term. So if the life insurance company came up with this term and the structure that I mentioned earlier is option B, there must be an option A. So to understand option B, maybe I should explain option A. And don't confuse option A and B with option 1 and 2, because they mean the same. So whether I'm talking about option B or option 2 or option A versus option 1, the bottom line is the life insurance company said there is an option we would prefer you use. This vehicle that we're going to walk through is using the one that is not first. So let's talk about the first option. And for that, you just have to think about normal life insurance. If I was to walk into State Farm and say, hey, I need life insurance, what type of policy would they traditionally sell me? Can we agree that it would more than likely be a term policy, something that will expire at some point?
Right.
Well, how does a term policy work? Well, I'm going to put in using this. Let's use easier numbers for me, at least $500 a month. I'm putting in $500 a month into this vehicle. Let's say that $500 a month is buying me $200,000 in life insurance, meaning when I put $500, when I pay my $500 premium to State Farm, if I step outside my front door and get hit by a bus, my wife will receive $200,000 as a death benefit due to the fact that I am no longer with us. Fair? That's traditionally what we're buying as it relates to a life insurance policy. Yes?
Yep.
Okay. Well, $500 a month is $6,000 a year. $6,000 a year times 10 years is $60,000. $60,000. Well, that $6,000 over 20 years would be $120,000. So let's say I've been putting away this $500 a month into this vehicle, all in anticipation. All there's a death benefit that pays out, right?
Oh, we lost your audio for a second.
Yeah. Can you hear me now?
Yep. Can hear you now.
Good. Okay, perfect. So, well, hopefully, anyway. Okay, so we're putting in that $500 a month over the next 20 years, which is $120,000 is what I would have contributed into this policy. If I now all of a sudden step outside my front door 20 years later, get hit by a bus, what are my beneficiaries going to receive? They're going to receive $200,000 because that is the contract that I signed with the life insurance company. My $500 a month affords my my beneficiaries a death benefit of $200,000 if something happens to me. Well, during that 20-year period of me contributing $500 a month, what did State Farm do with that $500 a month that I was contributing? Can we agree that State Farm is using that $500 to outperform whatever that death benefit is? Meaning their goal is to take that $500 a month and get it compounding. Slow, steady, securely grow it so that, God forbid, if something were to happen to me, they've already made their money back. Meaning I am an asset and they have made a gamble on me. They are saying that, you know what? I believe Donnell would outlive this life insurance policy. So of course we will give him $200,000 if something were to happen, because we know that over time, his $500 a month is going to make us way more. So an option A policy is saying this, or an option 1 policy is saying this. As you put in your $500 a month, and they're growing that $500 a month, that $6,000 a year, 60 over 10, 120 over 20. Let's say that 120,000 compounds to $500,000. God forbid, if something happens to Donnell 20 years from now, his family's going to receive the $200,000 we committed to, but that $500,000 we made, we get to keep that. Matter of fact, we get to compound that even more. Well, in an option B policy, not only is the life insurance company taking a part in me as the asset and that asset and the contributions that I'm putting into this vehicle growing over time, I get to participate in it as well. Meaning, as an option B or an option 2 policy, as I contribute this $500 a month, 60 over 10, 120 over 20, and as the life insurance company compounds this 120,000 to a half a million, it creates cash value. And that cash value is now a dollar amount that I get to use. I get to use that cash value, borrow against it, do infinite banking, hopefully put me in a position to where I can receive income from it. So I'm leveraging this cash value throughout my life. And then 20 years from now, God forbid, if something happens to me, not only do I get the $200,000 that I was originally promised, but I get all of the cash value, meaning my beneficiaries get all of the cash value that wasn't used. Why? Because the death benefit is two numbers. It's the life insurance I originally purchased plus the cash value that has grown over that 20-year period. So the difference between the two policies in that option A or option 1 policy, that $200,000 that I purchased for $500 a month, my beneficiaries only receive that $200,000 and I do not have access to any of the cash value that has grown. Versus an option B policy, not only that same $500 a month, not only do my beneficiaries receive the $200,000 that I was committed to, that $500,000 that it's grown to, I get to use over time, leverage, borrow against, take as income, do whatever I want to with that dollar amount. And in addition, my beneficiaries receive both the cash value and the life insurance that I was promised. So in essence, it becomes $200,000 versus, in this example, $700,000, which is better. And again, why would the life insurance company call one option 1 and one option 2? Meaning, which would they prefer you wanting? They would prefer the option 1 part. Why? Because they make more money off you. So you don't hear about it often, nor is it explained, because who benefits? Who benefits from us not knowing that there's an option A versus option B or an option 1 versus option 2? What's the benefit to those who are providing this product for making sure you understand these things? Which is why we do what we do. So does that help?
Yeah, Tom, let us know. Did it help?
And I know, again, I'm long-winded. So, but to me, I can't just tell you this is option B, because in truth, if you want to understand option B, you have to understand its brother, option A.
Yeah. Well, I understand that you're using the $500 across the board, but term policies are generally cheaper. And that usually is the draw for those types of policies, right?
So
And that's
on
why
that
people
note,
like Dave Ramsey suggest only do term policies. But we have term policies on, essentially, on health insurance are term policies, car insurance term policies. Any of those types of things require something to be wrong in order for you to really get the full benefit of having that insurance, right? In case something bad happens type of thing, versus being able to leverage it for prioritizing good things happening. So to me, option A says accident, right? Accident insurance, and option B is better. That's
right. And I think, but for some, a matter of fact, I've got a couple clients right like this right now. You know, we're going to dig into the crux of a IUL and break down how it grows and all of that. But some people can't qualify for this option that we're walking through, and that's okay. And some people, just want to make sure that they are putting themselves in a position so that they can leave a legacy for their family. So a term policy may make sense for some.
Better than nothing.
Right. There's nothing wrong with that. And so what I would say to that, though, is it all depends on the goal. What's the goal? Because if the goal is income, should I have an option A or an option B policy? That matters. If the goal is death benefit, if the goal is life insurance, does it matter if I have an option A versus option B? I think that's where it really, when you peel back the layers, it kind of hinges upon what the goal is. I'm sorry, sweetheart. Go ahead.
No, I was just going to say, I don't want people to think that it's this, not that, because it's far too common to see people who didn't have any type of insurance, and PSA, it's not okay. We all need to be insured, because it's not a matter of if we're going to, our clock stops at some point. It's just when. We all know that. So it should not be negotiable in 2024 moving forward. We're tired of the GoFundMe's and seeing people in those positions when we know for a fact that even a small term policy could make a difference. Not everybody's in the position to have access to an extra 10 grand just to be able to hold a service, and that's a heavy burden to leave to your loved ones. We've watched so many people go through this process, and it is heartbreaking to see that not only are they having to go through the stuff and the things, right, like settle up estate type of things, but they're also having to plan all of this stuff, and they did not have this type of, like many people, like the person who might have passed away, did not have access to these types of funds to be able to cover this. So then they go, hey, can you help us? And so we're all just passing the buck of, trying to help. Here's some help. And sometimes it does help, but it's avoidable is the point. It's completely avoidable, and it really impacts relationships going forward. It impacts a lot. But leaving stress is something that we're not doing if we plan well, and creating generational wealth prevents that. So that's really what I'll just stop there so we can get on with it.
No, you're good. You're good. So as I was saying, so an IUL, what is it about an IUL? Well, there's $2 amounts, well, an IUL compared to a secure compound interest account. Well, both a secure compound interest account and an IUL have this feature, meaning we're going to take a contribution. That contribution is going to go into this bucket, which is also called the general fund. This general fund is where that 0% floor lives, ultimately meaning there is a contractual guarantee that your contributions cannot be lost due to market risk. Again, there is a 0% floor there. But in addition, in this secure compound interest account, there is an additional, I'll call it match or contribution being added starting in year 3. And again, we'll dig into those details. So we just kind of want to kind of walk through those things. And to kind of highlight the example, what we'll be looking at today is I'm just following the same prescription that the video followed. So we're talking about a 35-year-old putting away $800 a month. And that $800 a month is buying approximately $250,000 in life insurance. So 35 years of age, putting in $800 a month. And again, where does that $800 go? That $800 goes into a bucket. And that bucket is what we call the general fund. And so $800 a month, 8 times 12 is $9,600. Again, this bucket is where no loss due to market risk happens. It's where the 0% floor lives. The cool part about the general fund is it's similar to a high yield savings account. Matter of fact, this general fund is exactly what is used inside of whole life policies to produce the guaranteed dividend of 4%. So it's the same bucket, has the same contents as far as how money grows inside of it. And it's just that this is a different vehicle compared to a whole life policy. Whole life, there's a guaranteed 4% growth. In IUL, there is not any guarantee on the growth. There's a guarantee that your money, the money that you've made, the money you've contributed won't lose due to market risk. But the growth inside of the vehicle, there is a range. And that range is somewhere between 3 and 7% over time. And if you look at the performance of the general fund since before the Great Depression, when was the last time that growth, somewhere between 3 and 7%, didn't happen? And the answer to that question would be never, meaning there has not been a year, there has not been a period where this general fund did not produce somewhere between 3 and 7%. So while I can't guarantee what that percentage would be, I can confidently say that average of 5% is pretty accurate. So in following this example, if I was putting away $9,600 a year inside of this vehicle in year 1, 5% of 96 is $480. Well, inside of an IUL, here's where you're going to introduce risk. And, as I mentioned, there's one guarantee that I talk about inside of a vehicle like this, and that's that 0% floor. Here is where risk is introduced. Up until this point, there hasn't been any risk. The dollar amount that has grown from the money that was contributed to the bucket, meaning the 5% growth on this 9,600, this $480 is now going to be taken and used to buy a one-time call option in the S&P 500 index. And again, this is a call option. So this, I'm not buying stock. I'm not buying an ETF. This is a call option on the performance of the S&P 500 index. Now, if this was any other IUL, there are many different, I'll call it call options and many different funds that can be used to buy that call option. In this particular, I'll call it vehicle, this premium finance strategy, they are all structured the same. Meaning we're going to take this 5%, this $480 and buy a one-time call option in the S&P 500 index. Well, what's a call option? Well, let's kind of dig into that a little bit. So to dig into that, I want to kind of just jump into year one and kind of use actual numbers, and I will explain the performance of the call option and how it works. But I will start here. Again, this is year one. Let's call it 2021. And we're going to use actual performance from 2021. So I've put in $800 into this vehicle. And then over the year of 2021, that $800 is turned into $9,600. And then again, 5% of that 9,600 is about $480 going to be taken, and a one-time call option is going to be purchased in the S&P 500 index. But what is that? Well, sorry. There we go. So what is that call option? What do I mean? Well, if you look at the performance or where the market ended in 2021, where did the S&P 500 open in 2021? Well, I've got that data. It's over here. So if we look at the call option performance or the performance of the S&P 500 index over the last few years, in 2021, the market opened at 3,700. And so someone far smarter than me is going to take that $480, the growth from the dollar amount in the general fund, take that $480 and buy a one-time call option and make an educated guess. They're going to make an educated guess saying, hey, since the S&P 500 opened at 3,700, I believe the S&P 500 is going to close higher than that. If the S&P 500 does close higher than that, the money that I use to buy the call option, I get to make more. So my money's going to grow. So in this case, taking that $480, buying a one-time call option, and the call option is saying, hey, I believe the S&P 500 index is going to close at 4,300. Again, it opened at 3,700. I believe the S&P 500 is going to close at 4,300. Where did it actually close? Like what actually happened that year? Well, what actually happened that year, again, 2021, is the S&P 500 closed at 4766 for a gain of almost 27%. So that call option did great that year. But to provide security in this account, meaning that 0% floor that I have on the dollar amount inside the general fund came at a cost. And that cost is I got the 0% floor, meaning I can't lose money due to market risk. But as a result, I'm not able to participate in the highest highs of the performance of the S&P. There's a cap on how much I can make off the growth on this S&P 500 call option. And that cap is 10%. So even though the market closed at 4766, which is an increase of 27% in the S&P 500, I didn't get to participate in the full 27% growth. There was a cap, and that cap was 10%, which means the money that I made, the $480 that I used to buy the call option, my total dollar amount inside the general fund, my 9,600, made an additional 10%. So again, I don't participate in the lowest lows. I don't participate in the highest highs. The 0% floor says, regardless of what happens with the market, I can't lose the money that I've made. And then the cap says, yeah, the market did 27%, but just to protect me, again, for security reasons, to protect me and my growth and my money over time, I'm not participating in the highest highs either. So there's a cap, 10%. So in this case, that 10% growth on the dollar amount that I contributed, I'm just using a round number. Let's just call it $1,000 for this example. So in essence, I used $480 to buy a call option, and that call option did great. And that 10% growth on that call option allowed me to receive and or achieve an additional $1,000 of growth on my total dollar amount, which means when I take this $1,000 and put it into this bucket at the end of 2021, my 9,600 made an additional $1,000. Awesome. And just so we're clear, for this example, I am not including any fees. We can talk about fees when we're done if you like, but I covered the fees last week when we were comparing them against a 401k. So those fees still exist, but I am not including any fees in these numbers, just so we're clear. So again, your 9,600 add an additional 1,000. So at the end of the year, at the end of 2021, you now have, what is that, $10,600 inside of this general fund.
Oh,
Well, that's the, go ahead, sweetheart.
We have a question.
Okay.
So I while we're in the spot, I want to make sure we address them.
Okay.
Richard says, wouldn't the 10% only be on the 480 wouldn't the 10% only be on the 480 used on the call option?
That is a great question. And because there's confusion here as well, and that is incorrect. You're buying a call option based off the total dollar amount inside the general fund. What we're using to buy that call option is approximately 5% or the growth on the dollar amount in it. So the performance, meaning you get the full complement of the 10% of every dollar in that bucket. And here's why that's important. Right now, what's in that bucket is just what I've contributed. But as the leverage starts to get added, there's a much larger dollar amount sitting in that bucket, which means I get the full complement of the growth of everything in that bucket, which is pretty powerful. So not just I'm making 10% on the money that I use to buy the call option. I'm actually making 10% on the entire dollar amount inside the general fund. And that, just so we're clear, that's all IULs, by the way. So this video that we played earlier, the IULs that she was referencing functions the exact same way.
Yeah. And also, Richard, the picture of your little guy in the middle there, so freaking cute. So sweet. Okay, go ahead.
Good?
Yep, I think so.
All right, so now let's jump into 2022. So where are we at in 2022? Well, in 2022, already sitting in the bucket is 10,600, already sitting there. And now I'm going to put in an additional $800 a month going into that bucket. So eventually there will be $9,600 on top of the 10,000 that I've put in. So 10,600 plus another 9,600 gives me 20,200. And again, like a high yield savings account, the growth on the money in that bucket is somewhere around 5%. 5% of 20,200 is $960. Someone far smarter than me is going to take this 960 and go buy a one-time call option in the S&P 500 index. Well, let's go back to the index.
Dang, I feel like
because now we are in 2022, right?
Yeah.
In 2022, what happened? Well, in 2022, the market opened okay, but the market did not close in a positive light in 2022. So in 2022, it opened at 47.96. And again, someone way smarter than me, some actuary, said, hey, we're going to make a call option on the S&P 500 and we expect it to close at somewhere higher than this 49.76. But what happened? The market lost 19.44%. So let's talk about it. The market lost about 19.44%. So again, the 960,000 that has grown off the money inside the general fund is going to be taken to buy a call option. Someone way smarter than me said, hey, we believe the S&P 500 is going to close somewhere around 4,900. It opened at 47.96, I believe. We believe it's going to close somewhere around 4,900. But what actually happened? What actually happened was the S&P 500 closed at 19%. It was a 19% loss in the S&P. But because of the 0% floor, all I lost was this $960, meaning the $960 went to buy the call option, the market crashed, and as a result of the market crashing and losing 19%, the money that I used to buy the call option was lost. My $960 gone. But the money that I put in the bucket and the money that I put in the bucket and the money that was already sitting in the bucket never moved. And so what that ultimately means was, hey, I didn't make any money here. Let's go here. I didn't make any money here. And I'm writing with my left hand, so I apologize. But anyway, I didn't make any money here, which means zero was credited to my account. So in essence, I ended 2022 the same way I started, or well, I guess in total, I ended 2022 with nothing more than what I had made in 2021 plus my contributions for 2022. There was no additional growth that happened in my account. And I lost this $960 that I used to buy the call option. But that's the end of 2022, meaning there's no other, I'll call it penalty associated with the money that I've contributed for this year. But okay, here comes 2023. In 2023, something special happens. And we always call it something special happens in 2020. What happens in the third year? What happens in the third year is the life insurance company says this: you've met your obligation in year 1 and year 2. What was your obligation? Your obligation was you contributed consecutively in year 1 and year 2. And as a result, starting in year 3, you are able to leverage everything that you contributed in year 1. So in year 1, I contributed $9,600, $800 a month. So in year 2, the life insurance company says, congratulations, we're going to match, or drop in a match into this bucket. Well, what's currently in the bucket? Well, what's currently in the bucket is my $20,200. And I'm now going to add an additional $800 a month into the bucket. But in addition, the life insurance companies comes along and says, hey, we're going to offer you a RELOC. This goes by many names. You've heard RELOC. RELOC stands for Retirement Equity Line of Credit. You've heard match, similar to the match of a 401k. But in truth, all we're talking about is a participating loan. Anyone who offers any type of cash value life insurance policy understands what the participating loan is. The participating loan is what people who do infinite banking use to go do infinite banking. They borrow money from their policy. It's the same participating loan. This isn't something brand new or extra. There isn't any magic here. Because you've contributed consecutively in your policy, the life insurance company says, hey, starting in year 3, you're able to leverage everything from year 1. Leverage just means borrow. So if I contributed $9,600 in year 1, I'm able to borrow that $9,600 and dump it into this vehicle. So I'm able to borrow this $9,600 from the life insurance company, take that $9,600 and put it in this vehicle along with my $800 a month. So in essence, make this a little bit bigger. So in essence, in 2023, what happened? In 2023, my $20,200 that was left over from 2022, plus the additional $9,600 that I just contributed, and there should be a K there. Get rid of that K. There we go. And that $9,600 that I just contributed, both of these dollar amounts are going to make me, again, around that same average of 5%. But in addition, the $9,600 that I borrowed from the life insurance company is also going to make the same 5% sitting in this bucket. This $9,600 that I borrowed from the life insurance company isn't doing anything different than what my current contributions are doing. So again, this isn't magic. This isn't the 9,600 is doing something special that maybe I don't know about. It's doing it's taking the exact same path as my contributions. Nothing different is happening here. And I'm keeping it separate so it's easier to understand. My money is going to make on average 5%, $1,440. The $9,600 that I leveraged or borrowed from the life insurance company is going to make on average that same 5%, which equates to about $800. So the $800 that I've leveraged and the $1,440 that my money has made, both of those we're going to use to buy a one-time call option in the S&P 500. Well, how did the S&P 500 do in 2023? What did that performance look like? Well, again, if you remember in 2022, the market crashed, right? We lost 19%. So the market opened at somewhere around where the market crashed, which was it opened at around 38.24. And someone way smarter than me, some actuary, is going to take the $480 of the money that I've leveraged and the $1,440 of my own, take those $2 amounts and say, you know what? I believe the S&P 500 is going to close somewhere around $4,000 points. Well, where did it actually close? It actually closed at 43.76, which means in 2023, my money that I used to buy this call option made an additional 10%. Even though the S&P 500 itself closed at 43.76, which is an increase of 14%, there's a cap on how much my money can grow. And again, that cap is there intentionally. That cap on the growth also protects me from what happens if the market crashes. If I didn't want the cap, I could remove the cap. But if I remove the cap on the top, I remove the cap on the bottom. So which would you prefer? Base hits over time or home runs and strikeouts? Me personally, I would like consistent base hits. Why? Me never losing will outperform you winning and losing every time. If I could never lose, if you could put yourself in a position where and you name the game, it doesn't matter the game. If you could play a game where you never lost versus playing a game where you win a lot and you lose a lot, which one would be better over time? And it's the art of not losing is what generates the ability to produce this compound interest effect that allows you to outperform other vehicles. So in this case, in 2023, the market performed at a positive 14%, which means my money grew 10. So 10% on the money that I contributed. Again, the $14.40 that I used to buy this call option made me about 10%. The $400 that I leveraged from the life insurance company also made the same 10%. But here's where we get into the fact that nothing is for free. I borrowed this money from the life insurance company, but I did not get this money for free. It came at a cost. There was a cost to doing business. There is not a bank in this world that you can borrow money from for free. Well, the life insurance company functions the same way. This participating loan came at a cost. So they said, yes, you can borrow everything from year one and you can put it into year three and you can use it. Absolutely. But there is a cost, and that cost is 4%. Well, if the money that I borrowed, meaning remember this 96, this growth right here, this growth is based off the money in the bucket. So I made 10% on the $9,600 that's sitting in the bucket. But the life insurance company says, hey, before you take your 10%, I'm going to need my 4. Well, once I pay the life insurance company the 4% that I owe, and just so we're clear, where does that 4% go that we pay the life insurance company? That 4% goes right back into this bucket. And I know I am covering so much that this goes over people's heads a lot. But the piece that I just want to connect you to as to why this is important, meaning I made 10%, it cost me 4%, I paid the life insurance company back the 4%. The key is, where did I pay that 4% back to the life insurance company? I paid it back to this $9,600 in this bucket, which means every year, not only am I leveraging the life insurance company's money and making money off the life insurance company's money, I'm also leveraging the life insurance company's money and the money that I paid back to the life insurance company. Meaning, the dollar amount that I'm leveraging starts out like this. But the reason it becomes like this is because not only am I adding more year over year over year, but any money that I pay back to the life insurance company gets added to that bucket, so it becomes even larger. So the 10% that I made on the money that I've leveraged cost me 4%. That remaining 6 is mine. So the 4 that I paid back goes in this bucket, and the 6% that I made from the life insurance company also goes back into this bucket. And then obviously, in addition, my money made 10%. So what does that look like?
We have questions when you're ready.
All right, let me knock this out and we can answer those questions. So at the end of 2023, what did it look like? In total, my $29,800 made 10% on my money plus 6% on someone else's money. Questions you got, babe?
Okay. First up, Peaky says, so the general fund includes contributions from all policyholders as a pooled fund rather than being segregated for each individual policyholder. So the call options are not segregated either, correct?
That's it. It's the life insurance company saying, well, also, let's step back on that question. Let's step back a little bit. We're talking about life insurance companies that's been around for hundreds of years, right? Since before the Great Depression.
Yeah.
And these life insurance companies love making money. Can we agree?
Mm-hmm.
They wouldn't have been around hundreds of years if they didn't. And they have so much money at their disposal that they're not interested in home runs. So they're not interested in making a lot of money.
Or
They
taking a
want
lot of
slow,
risks.
steady, and secure growth.
Right.
So in order to have slow, steady, and secure growth, they have to place their money in secure positions. So this general fund is what's considered that secure position. And no one has asked yet, but what is comprised of this general fund? What is it about this general fund that makes it secure? This general fund is comprised of AAA rated bonds. You know, the bonds where when you have your 401k and you're getting old enough to where it's time to retire, they say, hey, we need to get your money out of these aggressive mutual funds and stocks, and we need to move them into bonds. Why? Because the bonds are secure. And putting your money in bonds allows you to be able to keep and retain the money that you have so you don't run out of money while in retirement. Well, this is no different. This general fund is comprised of AAA rated bonds, which means it's a very slow, steady, and secure growing vehicle. And you're right. It's not the money I put in it is in this bucket today, and the money that you put in is in some other bucket. It's the same account. It's the exact same account that whole life people take their 4% dividend from. So when you hear people talking about how piss poor IULs are, what they're not telling you is their 4% guaranteed growth is coming from the same bucket. So make it make sense.
That part. And the income is the important part. And I wish that we had more conversations around inflation and just in general and safeguarding ourselves against inflation. Because if we're not paying attention to what people in general are going through right now, you could assume that maybe you're comfortable right now. And so therefore it doesn't matter. You'll figure it out later until you can't. And you had mentioned something earlier today around adding a compound cycle, that the difference is that you're able to add an entire compound cycle to the equation in one of these vehicles over the other. That's significant.
And you're giving the answer to the test, and the
Oh.
test isn't over yet.
Okay, my bad. It's the cheat sheet. That's what it is. Okay, we have one more.
Yep.
Zaid says, does the 10%, does the plus 10% cap that wasn't received by the policyholder go somewhere else, or does it just go to die?
Does the plus 10% cap that wasn't received
By the
what does that mean?
policyholder. So
Oh, meaning if I pass?
does it go, policyholder go somewhere else, or does it just die? Yeah, I guess I don't understand. Maybe you could clarify, Zaid, what you mean by that, because I'm a little confused too.
Does the 10% cap
Because show
that
the
wasn't
graphic,
received?
like squeeze it
Talking
down
about
for
that
us.
graphic?
Mm-hmm.
Because again, I guess I'm not understanding the wasn't received. That's the part that's throwing me off. Because if there's a dollar amount that's taken from my general fund and a call option is purchased, the growth at 10% dollar amount, whatever that 10% is, it's going back into my general fund. Like it's no different than a high yield savings account. The interest is going to be paid.
Do you
Now,
mean,
go ahead.
do you mean in a whole life policy? Maybe he means in a whole life policy.
Well, and again, the difference is the life insurance company is taking this dollar amount and they're growing it slowly and securely. All a whole life policy is saying is you don't get to participate in any of that growth or any of that 0% down, like I won't call it downfall, but that I'll call it that no growth from that 0% floor. You get a guaranteed 4% for the rest of your life. Like that's awesome, but it doesn't necessarily translate to income.
Yeah. Okay, Rosalind has a question. She says, if the insurance company made 20% and only gave me 10%, where does the other 10% go?
I love it, love it,
Y'all
love
got
it, love
each
it.
other's back
Here's
in
what
here.
you
I
have to
love it.
remember.
Yeah, that's a good question.
It's an awesome question because let's understand this bucket. This bucket is the general fund. It's not the general fund for me. It's the general fund for the life insurance company.
Yeah.
So what did the life insurance company make? They made the same 10%. They didn't make above the 10%. Again, this is about security. The life insurance company does not care about home runs. They also don't want any strikeouts. They only care about base hits. So it's slow, steady, and secure growth. So what we're talking about is this dollar amount that's in this general fund functioning under this umbrella. Everything in the general fund, not just my money, everything in this general fund only made that 10% cap. And again, it's compartmentalized and it's segmented dollars, right? Because there are other, I'll call it compartments within the general fund that are also invested in other index funds, meaning the dollar amount in this general fund that is focused on functioning in this fashion, all of it functions this way. But guess what? I can absolutely remove the cap, and I can also not invest in the S&P 500, and I can use the Bank of America index fund if I wanted to. But this strategy, this premium finance strategy, they all function the same. It's all focused and it's all invested in the exact same index fund with the exact same cap. But you do have the ability. It's no different than you have an account with Fidelity, and Fidelity says, "Hey, this is the target date fund that we've put in front of you." Well, you have the ability to change out some of those mutual fund stocks and bonds for others, right? You can invest in anything that they have to offer. This actually is no different. It's just that the premium finance strategy that we use, MPI, it's all structured the same way. Why? Our goal, the main focus is income. So how do you achieve the most amount of income? It's about this structure, max funded option B IUL with leverage. And that leverage can't be uncapped. Because if it is, then the ability to have that 0% floor is gone, which means that security is lost. The whole point in doing this is to make sure we don't lose the money that we've made. So hopefully that kind of clears that up, meaning everyone inside that bucket is performing under the same guys, that 10% cap.
All right. Are we ready to go to the calculator?
And we're just about done.
Oh, okay.
I just wanted to, I won't go in. Well, let me just, I guess I got to do it since it's here. So that was 2023. I wanted to highlight 2025, and I won't fully go over 2025, but I just wanted to highlight it for a minute. So again, in year 1 was our contribution. In year 2 was our contribution. In year 3, we borrowed everything from year 1, added it to our contribution in year 3. In year 4, we're going to do the exact same thing again. But in year 5, something special happens. In year 5, you just met the original obligation for the second time. What do I mean? Well, at year 3, in order to borrow from year 1, all you had to do was consecutively fund your policy consecutively for year 1 and year 2. So you funded it consecutively in year 1, funded it consecutively in year 2. At year 3, you were able to borrow year 1. Well, notice in year 5, you just did it again. In year 5, you just funded your policy consecutively for year 3 and year 4. So therefore, in year 5, not only are you able to borrow from year 1, but in year 5, you're able to borrow from year 1 and 2. So what does that look like? Well, if I'm able to borrow from year 1 and year 2, what was year 1? Year 1 was 9,600. Year 2 was 9,600. So I'm able to borrow double the amount and add that dollar amount on top of everything that's sitting in the bucket. So this 9,200 plus my 800. So the year 4 dollar amount, I guess I can make this bigger for you. Oh, can I? Okay. Yep, there it is. In year 4, the dollar amount from year 4 added to the 9,600 from this $800 a month that I've contributed. Obviously, 5% of that is what I'm going to use for the call option. But the 90 from year 3, that borrowed dollar amount from 9,600. In year 4, the borrowed dollar amount from 9,600 plus this new dollar amount is also going to be added inside this bucket at year 5. So all of this is now working for me. And all of this, again, the growth of on average somewhere around 5% is what's going to be used to buy that call option, which means at the end of year 5, I have whatever that year 5 total is, whatever this dollar amount is, plus 10% on my money, plus 6% on the leverage dollar amount is what's mine. If this was just an IUL, what would you see? Like if this wasn't a premium finance strategy and you didn't have the leverage, what would you see? Well, it would look something like this. The IUL would be performing at, hey, I've got $800 a month over the last 10 years, which is a total of $96,000, which I would have contributed, which means on average, that growth would have looked like somewhere around 7%. So in that video where she was talking about a 35-year-old putting away $800 a month until age 67, in a 10-year span, this is what the performance would have looked like. But what would it have looked like in a premium finance strategy? Well, the contributions would have been the same, meaning, notice, this dollar amount and this dollar amount is the exact same. The difference is the leverage. The difference is the match. And as that match continues to compound and get bigger, notice I've put in the same $96,000, but there's an additional $192,000 working for me. And again, on average, that growth is right around 3%. So I'm making the same 7% on the money that I've contributing, but in addition, there's an additional 3% on someone else's money that's working for me as well. Just from a simple math perspective, why wouldn't I want one over the other? Because again, the vehicles are structured the same, max funded option B IUL. The difference is this piece. And so in what it looks like over time, again, following the same perspective of the buckets, what it looks like over time is, yeah, in year 1 and year 2, you're making 7% on your money. But year 3 and year 4, you're making 7% on your money plus 3% on someone else's money. But as this thing starts to compound, it just continues to get bigger. Whereas your IUL was only doing this. So if you had the option of leveraging someone else's money at no risk, remember, that dollar amount that you're leveraging came at a cost, but that cost is being covered based off the growth inside the policy. And even when it doesn't grow, you're still protected. But the bottom line is, which would be better? Just having that 7% growth over time or having this other leverage dollar amount also working for you? It becomes just simple math. And so, and here's what I mean. Going back to the original example.
We have
Go ahead, sweetheart.
We have some questions while you're there, I think.
Okay, because where I was headed was the calculator, but go ahead.
Yep. It's Tom says, did I hear in a previous live that 3% RV occurs every 3 years?
So, and because I know I move so fast and I know it gets confusing. So I've contributed whatever I've contributed in year 1. I've contributed whatever I've contributed in year 2. At year 3, I'm able to leverage everything from year 1. At year 4, I'm able to leverage everything from year 1 again. But at year 5, I'm able to leverage everything from year 1 and year 2 at year 5. So is it every 3 years? At year 3, you leverage year 1. At year 4, you leverage year 1. At year 5, you're leveraging years 1 and 2. At year 7, you leverage years 1, 2, and 3. At year 9, you leverage years 1, 2, 3, and 4. At year 11, years 1, 2, 3, 4, and 5. So is it every 3 years? No, it's at the 3rd year you start adding leverage, and then every 2 years that dollar amount doubles.
Boom. Psh, I need a blowing up sound. Explosion.
But again, I know, and so just so you know, letting you guys into some of the conversations we have around these lives, I am committed to doing this over and over and over and over and over again, only because it is not easy to pick up. And we've been so conditioned to believe that the 401k is the answer. We've been so conditioned to believe that the Roth IRA is the way we're going to get there. In order for us to understand that this vehicle might be a little bit better, it's going to take the same amount of conditioning. It's going to take the same amount of repetition. We're going to have to do this over and over and over. You're going to have to hear the same questions over and over and over again. You're going to have to see the same buckets over and over and over again in order for this to stick. At least that's my perspective.
Yep. And that's okay. Some of us need to see it a couple of times, and we're here for that. We're here to support each other too. Wait, we have more questions about that part. Okay.
I love you.
You just wanted to move on, bro, and you can't. Okay. We need time. We need to sit here and marinate for a second. Lewis says, what happens to, well, hold on. Lewis is like, what happens to my funds if the 2025 call option takes a hit? What then pays back the 4% loan?
Okay. I was
Lewis
trying to
is
get
like, I need
beyond
the
that.
receipts. We need the forecast. What's the weather going to look like if
Can
this
I
happens?
ask that we pause that question? Because I will explain it and I will explain it in detail. But let me wrap up this video real quick. Meaning, what we're comparing is an apples to apples around. She stated a 35-year-old putting away $800 a month was going to look like a certain dollar amount. And I just want to compare that to an IUL. And then I will go back and show you what happens if the market crashes and you are borrowing money from the life insurance company. I will break that down.
Okay.
Is that fair?
Deal.
Okay. So hold it for me. I will come
Okay.
right back to it. Matter of fact, go get your friends because they probably want to know about it too. Because this is one that
We'll
we
be
get
right
asked
back.
often.
Okay.
What happens if I have this leveraged dollar amount from the life insurance company and the market crashes? Like, this is a very, very important question. So please, this is the moment because I'm going to jump into the calculator and jump out. Go ask it. Go tell your friends to jump on because I will break this down. It's not a problem.
There's a lot of jumping going on here. It's like a crisscross live stream. All right.
So, and again, what she stated was, what I want to use, I'll use that. $800 a month, which is $9,600 every year, contributed till age 67, which equated to a total contribution from his part of about $307,000. I know it's kind of small, and I'll make it bigger. And which ended in cash value, this is the cash value column, in cash value of right around $816K. 816,180 is what she said. So I'll make this a little bit bigger and go over it again. Putting in $800 a month equates to $9,600 a year every year till age 67. And by age 67, the contribution amount for him, for that 35-year-old at age 67, would have been a total of $307,000. Well, at that $307,000 mark, at age 67, the cash value, and what is the cash value? The cash value is the money that you are able to use as income. The cash value is the amount of money that you are able to leverage, borrow against. It is your liquidity. The cash value is your bank account. The cash value is everything that you want to do with this policy outside of this policy is where you're going to get that dollar amount from. So from age 35 to 67, that's 32 years. From age 35 to 67, that $307,000 would have turned into $816. So again, these are the numbers. $9,600 a year till age 67. They would have contributed $307,000. That $307,000 would have turned into $816. What does this exact same dollar amount look like in a secure compound interest account? So now let's go to the calculator.
Oh, okay. Here we go. To the calculator. Okay, we're at the calculator.
Yeah, the calculator is deciding to take its own sweet time. So
Yeah.
again, 35 years of age.
It's because you put off Lewis's question.
Yeah, I know.
It's
But I
protesting.
promise I'll get there. And it's going to be wonderful too. I promise
Okay.
I will get there. So again, 35 years of age till age 67, putting away $800 a month. What does that look like? Well, I'm not even worried about the income yet. What was stated was the $307,000 that would have been contributed into this vehicle. So it's the same $307,000. This isn't a different dollar amount.
Mm-hmm.
The same dollar amount in the same, I'll call it structured vehicle, max funded option B IUL. The difference between this video or the video that the lady was kind of walking through and this vehicle, the difference between these two vehicles is this dollar amount, the leverage. The 7 plus 3 plus 3 plus 3 plus 3 plus 3 plus 3 plus 3. Well, this is the plus 3. So when that $307,000 gets an additional leverage dollar amount of $2.8 million, can we just agree if you had an additional $2.8 million working for you, whether the market crashed sometimes or not, if you had $2.8 million working on your behalf, can we at least agree you would have more money than just the $307,000 working for you alone? Like, Can we just start there?
Right.
And now as a result, we're talking about cash value at age 67 of 1.4 million. 816,000 compared to 1.4 million. So what I want to show you in the calculator, at what age, because this is at age 67 for both of these vehicles, right?
Mhm.
At what age would this 35-year-old actually have the same 816,000? Meaning, if at age 67 it's 1.4 million, at what age would it be 816,000? Because that's the dollar amount inside of this IUL at age 67. So at what age? And again, I already know the answer to the test, right? So I'm going to back this down to 61. And again, it doesn't matter about the income. The piece I want to show you is the cash value. So at age 61 is when the exact same dollar amount would have been achieved in this vehicle compared to the IUL. 61 to 67, that's 6 years. That's a whole compound cycle. Meaning, just having your money in an IUL, you lost an entire compound cycle. You lost the entire amount of time that it would take for your money to double one time just because it was in a different vehicle. Just because, again, properly structured. Is it properly structured? It absolutely is. But this vehicle allows for leverage, whereas the vehicle that your money was in does not. You lost an entire compound cycle as a result.
Well, and in your 401k or IRA, you can
Oh.
lose up to 19 years because of
Okay.
fees.
Okay. Let me make
That's
this
more
bigger.
than one compound. That's like more than like 2 or 3 compound cycles.
Let's make this bigger so you can see it. So if you were to put the same 249,000 at age 61 into a 401k, matter of fact, let me do this a little bit better. This
Well,
401k is showing,
this is saying Roth, not
no, it's saying
traditional
a 401k or a Roth IRA.
Oh, got it. Okay.
So I'm going to change the growth to 10%
Mhm.
instead of 9. So let's say it's doing even better.
Okay.
Okay. So again, it's the same 249,600 contributed over time.
Mhm.
And again, it's not 307 because we backed the age down to 61. So I can put the age back at 67, but we back the age down to 61. So it's the same 249,000 contributed. And I'm saying a growth of 10%. I know you can't see it because it's too low, but I'm saying growth of 10%. What does that equate to? Well, inside of this vehicle, 829,000. Inside of a 401k, $1 million. You're a millionaire. Congratulations. You have $1 million inside your 401k. Okay. Or you've got $1 million inside your Roth IRA. Doesn't matter. You believe your financial advisor is going to tell you that this is better than this.
Well, because they're only showing you the top part.
Because they're only showing you the net worth.
Yeah.
So we have been convinced, we've been conditioned, not convinced. We've been conditioned to believe that net worth means more than income. And that's not true. Just because you have a net worth of $1 million doesn't mean you can spend $1 million. This is where the whole safe withdrawal rate discussion comes back full circle. The safe withdrawal rate is the amount that you can take in income so that you don't run out of money. Well, if you're making 10% inside this vehicle, the max you can take in income, and I don't care who you talk to, you can go to Edward Jones, Morgan Stanley, Vanguard, BlackRock. It doesn't matter where you go. They all use the same structure to determine what you can take in income out of your retirement, and it is 4%. So the income difference between this vehicle and a secure compound interest account is your 401k is based off the 4% rule, and a secure compound interest account is not impacted by it.
Well, and don't forget taxes.
Again, I didn't mention fees in this product, so I didn't mention taxes intentional, but you're absolutely correct. You also have to take taxes out of this dollar amount, whereas this is a tax-free dollar amount.
Yeah.
So which is better? Just mathematically, which is better? And then I go back to the original IUL conversation. If you're losing an entire compound cycle, what that means is the amount of income you're able to take inside of a regular IUL, properly designed, properly structured. She did nothing wrong in that video.
Right.
That video was done, I thought, very well. She explained the different segments of how retirement dollars grow. I thought that was awesome. And the IUL that she shared on the screen was properly structured. Max funded option B IUL. Awesome.
Mm-hmm.
But it's not an apples to apples discussion. Why? Because this is focused on income.
That's right.
And in order to produce that income, you do need help. And that help just looks like leverage.
And to
You
that
add
we
this
say,
dollar amount. How about this? You add this dollar amount to the 401k. I think we would agree that 401k is awesome. You add this dollar amount to an IRA. I think we could all agree that IRA is awesome. You add this dollar amount to anything, it outperforms, outproduces anything that we've discussed. And that's what this vehicle does. All right.
and
So I'm
to
off
that,
that.
and to that, you messed up my joke earlier. And to that we say, ta-damn, because ta-damn's in the house and it's right on time, if you're asking me. All right. We have questions. We have questions. And
So
I think we're
we
going
can, I can answer questions here if we want, but there was a question that was asked, but what happens in this properly designed, properly structured vehicle if we're leveraging this money from the life insurance company and the market crashes? So if we want to go down that path, we can, or if there's some questions around these numbers, we can discuss those as well.
Well, you want to answer that right now? Is that, you want to do that here on the calculator?
I can't. We're going to have to go back to a bucket for me to explain that.
Okay. Well, let me get all the questions up here then.
Okay.
We had a really important one just a little bit ago. Oh gosh. Oh, no. Oh, here it is. CJ Inc. wanted to know where the likes at though. And that's what I'm saying. Where the likes at though. You know what I mean? Where the likes at.
I think, I go back and
Where the
forth. You and I
lights
go
at,
back and
though.
forth about this a lot, right? This is a service and this is purposeful. And because people ask me all the time, why aren't you guys bigger than, like, you should be bigger than this? Like, I think we're growing just like we're supposed to.
Yeah, well, I don't know. I think we could be doing the type of videos that help us get more reach. That would mean that we would have to be doing videos for that sake. Those are 12-minute videos, by the way. That's what the attention span is. And Donnell refuses to cater to an algorithm, and he will not. If something needs to take 40 minutes to explain, we're gonna be here for 40 minutes, guys.
But okay, I
You ever
could do
been to a
that. I
church
could do
and
what we
you're
just
sitting
did in
there?
12 minutes. But would you like that? Like, I could
No.
walk through that information in 12 minutes.
No, we're oh dang.
You didn't lose it, did you?
I pulled the trigger too fast on the Tadams. We'll do it one more time so he can hear. She said, "Oh, her husband's about to walk in the door." Shh, everybody. Okay. Louise says, "Can I ask why this MPI company, are they trustworthy?"
I love that. I love that because there's clarity that is involved here. That whole example that I walked through, what is actually being purchased? Like the 35-year-old that's putting away $800 a month, what is actually being purchased? What's being purchased is a life insurance policy. A life insurance policy for $250,000. That life insurance policy is from a AAA rated life insurance company that's been around since before the Great Depression. MPI is not a life insurance company. You are not buying MPI. So what is MPI? Maximum premium indexing is a strategy. No different than infinite banking concept. It's a strategy. No different than velocity banking. It's a strategy. You can't buy any of those. You cannot buy a velocity banking thing. You can't. It's a strategy applied to the money that you have to be able to help you pay off debt. Infinite banking is a strategy applied to a cash value life insurance policy to allow you to be able to free up the cash value to do what you want. MPI, maximum premium indexing, is a premium finance strategy applied to an IUL that allows you to leverage the money inside the policy to help it grow faster. So is MPI credible? Like, we can go down that path because we can Google them and go, like, we can absolutely vet MPI and where that came from. But the key piece is this. MPI is a strategy. Where did that strategy come from? That strategy came from premium finance strategy. Where did that come from? Premium finance strategy is a strategy that started in 1997. What else started in 1997? Roth. So when Roth was introduced in 1997, the life insurance company says, wait a minute, that's pretty awesome that you get to pay taxes on your dollar amount today and grow tax-free dollars. Like we as the life insurance agencies would love to be able to participate in this process of growing tax-free dollars. And so they created this strategy called premium financing. Google it. Premium financing is a strategy where high net worth clients of life insurance companies borrow money from a bank, add that borrowed money from the bank into their policy to help grow their policy exponentially fast. Well, if I'm going to borrow money from a bank, I need to have pretty decent credit to do so. And so if you look at a premium finance strategy, you have to have $5 million in net worth and A1 credit. All MPI is the premium finance strategy without the bank. How do you remove the bank? Like if you don't need the bank's money to add to your policy, then what do you use? How about we use your money? Meaning, if you've contributed consecutively in year one, $9,600, and contributed another $9,600 in year two, the life insurance company says, hey, congratulations. We are going to allow you to borrow everything that you've put in year one. We're going to allow you to borrow it from us, the life insurance company. We're just going to use your money as collateral. So there's no loan documents that you have to fill out. You don't have to qualify. You don't have to have great credit. You don't have to have $5 million in net worth. Why? We already have all of your money. The $9,600 over the last 3 years are sitting in the general fund. The general fund is the life insurance company's bucket. So they already have all of the qualifications they need from you in order for them to allow you to borrow $9,600 from them. And all we're doing is taking that $9,600 and putting it back in the general fund. So this prompts another question that you didn't ask, though. What's the risk to the life insurance company to allow you to borrow $9,600 from them? What's the risk? For that, you have to remember the general fund. The general fund is this bucket with this 0% floor that allows your money security, meaning there's no loss due to market risk inside this bucket. So the money in the bucket is secure. So what's the risk to the life insurance company to allow you to borrow money and put it in the bucket? Well, if the bucket is where the security lives, there's zero risk to the life insurance company to allow you to borrow this money. Okay. And why would the life insurance company allow you to still, okay, there's no risk, get it. But still, why would the life insurance company allow this? I think we can agree that the life insurance company are capitalists. Their objective is to make money. Well, if they allow you to borrow money with no risk and then charge you 4% on the money that they allowed you to borrow with no risk, sounds to me like they make some pretty easy money for doing nothing. Because let's be clear, if we go back to the calculator, that dollar amount that you were making, the dollar amount that 35-year-old was able to leverage at age 67 or 61 as income, pales in comparison to the amount of money that the life insurance company made.
Okay, well, no more questions that he may not have asked. Okay, because we got a lot more questions, right, Luis? Luis also says that he's been following and implementing velocity banking, and this has helped a lot. Luis, what I wanted to go over tonight, which we will have to save for Sunday and start that next week, is going back and digging into reverse velocity banking and how to use that same sort of concept. If you can wrap your head around velocity banking, using that same concept to build wealth instead of just eliminate debt, and doing that inside of vehicles, and how to accelerate your leverage using cash flow and your leverage in that same type of way. You're just reversing it. So we're going to be diving into that starting next week, right?
What you guys have to catch, if you've been following us for a while, we throw subliminals at each other and we end up talking about them later. So I don't know that you really just caught what just went down there. She has just
Jab,
determined
jab.
what we're going to, because she's already set you up. So now I can't come back and say, well, I think it would be best that we cover A, B, and C, because she's already hit you with C and D, and I have no fight against that. Like she's good at what she does.
No,
man.
because sometimes you say, oh, and we're going to go more into that next week. And I'm like, this is now turned into a 7-part series when we need to go back to this other thing we said. Remember that part?
No, you're amazing at what you do. That's all.
Well, so are you. Thanks. Okay, moving on. Marriage. Okay. Let's see. Let's see. Donnell, how do I pay my bills if there is not interest earned for a year or two? It's a great question.
So, in order to explain that, I think what I have to do is just break down what happens if the market crashes and we are leveraging money from the life insurance company into a vehicle like this. And so I think to answer that specific question, I think it starts with understanding how money is distributed in this vehicle. And I think that will answer the question. So what I mean is I'm going to answer it indirectly. So in order to do that, I want to walk you through how money grows inside this product and what happens if there's no money earned, meaning if there's a down market for that year. And so for that, we need to jump back over to the vibe board, sweetheart.
Okay, because Lou, I skipped. I went, for some reason I skipped. I think this is a great time to bring up Lewis's question too.
Yeah, because they both go together. Yeah,
Right.
absolutely.
What happens to my funds if the 2025 call option takes a hit?
Yep.
What then pays back the 4% loan?
Absolutely,
Let's get into
because
it.
whether we're talking about the 4% loan that I owe back to the life insurance company,
Right.
or if I'm taking income at this time and the market crashes, the impact is the same. And this vehicle has to be able to compensate for both. This vehicle has to not only pay back the 4% that I owe to the life insurance company, but this vehicle also has to continue to produce the income that I need now that I'm in retirement, regardless of whether the market crashed or not. And again, so to explain both of those, I think the best thing that we should do is explain what happens when the market crashes and how the vehicle compensates for a 0% year when leveraged dollars are impacted.
Yeah, because
Okay.
just because you say so doesn't make it true, right?
Right,
And
right.
I appreciate that. So let's walk it back.
So for that, what I want to do is I want to walk through an example. So this is going to be a brand new example. We're not doing $800 a month. And the reason I'm starting with a brand new example is so that I can just use simple math. So the year is 2015. So what happened in 2015? Well, in 2015, the market crashed. And what I want to walk through is if inside the general fund, there were $2 amounts working for me, 10,000 of my money plus 10,000 that I borrowed from the life insurance company. So there's $2 amounts sitting in this bucket. There's the 10,000 that I've contributed, and then there's the 10,000 that the life insurance company allowed me to leverage or borrow to work for me inside the bucket. So again, inside the general fund, there are $2 amounts, what I've contributed and what I'm now borrowing from the life insurance company. And I think as everyone seems to have gotten it based off the questions, I am not borrowing that money for free. There is a cost to me borrowing this money. So I want to highlight some things. There are two things that are going to happen as a result. And these two things that happen, you won't notice either one of them.
Okay.
So
wait.
go ahead.
Wait. Okay. Just one more thing, because Rosalind has a great question, and I think it would probably help people connect a dot here. She has a question that I think probably a lot of people have. She said, crazy question. How does the MPI product provide the leveraged money? How do they do that? Like what's the difference of how MPI is a part of this product versus like the IUL, and who's making those decisions like specific to MPI in this process?
So
I
would
love
you
that
leave it up
question.
for me as well?
Yeah. Mm-hmm.
Because first step is MPI is not a product. You cannot buy MPI anything, maybe a t-shirt.
You definitely can
MPI,
get a
maximum
shirt.
premium indexing. Say it again.
You definitely can get a shirt.
Right. MPI, maximum premium indexing, is a strategy. Again, no different than infinite banking. Infinite banking is a strategy. You cannot buy an infinite banking whole life policy. Doesn't exist. You can buy a whole life policy, you can structure it effectively, and you can use that whole life policy to do infinite banking. Velocity banking is a strategy. You cannot buy a velocity banking home equity line of credit. You can't. You can get a home equity line of credit, and you can leverage that home equity line of credit to do the strategy of velocity banking. But velocity banking, can't buy it. It's not a product. Infinite banking, can't buy it. It's not a product. MPI, maximum premium indexing, is a strategy. It's a premium finance strategy. Very important. Now, this strategy, who applies this strategy? Meaning, if I buy an IUL designed for premium finance, meaning I buy an IUL and that IUL is structured for MPI, maximum premium indexing, who applies this strategy? Like, what's my role compared to the MPI policy that it seems like we're getting, right? Who applies the strategy? Well, that strategy is absolutely provided by me. In order to get an IUL structured for premium financing, or an IUL structured for the MPI, maximum premium indexing strategy, what that means is you are making your normal contributions on a monthly basis. Your sole responsibility is to simply contribute to the policy. Using that example, $800 a month, whatever it is, that is your sole point, purpose, only job in this process, to contribute $800 a month. Well, my job is at year 3, I'm going to pull up your account and I'm going to see that, yep, she's contributed $9,600 in year 1. Yep, she's contributed $9,600 in year 2. Congratulations. You are now eligible to borrow everything from year 1. So I am going to put together the proper documentation for you to borrow everything from year 1 so that year 1 dollar amount can be added into this product. So that's my role, my responsibility. And, there's a team, obviously. There's an enforced team that also helps us with this process because there's a lot. But the bottom line is it has to be managed. And that strategy, before any change can be made in your policy, because what did you buy? You bought a life insurance policy. Before this structure can be added, you have to approve it. So your job is to contribute on a monthly basis. And then when it comes time for leverage to be added into this policy, your other job is to approve this leverage being added. But it's my job to break down, one, what needs to go there, how it needs to go there, what's the documentation required to be able to do it, and what does that strategy look like over time? And I think the next question that's probably going to come behind that is, but what happens if I'm not here? So that's where the umbrella of MPI comes into play. MPI is a strategy, and that strategy is comprised of about 100 certified advisors who understand, because every, not some, every MPI strategy, every strategy is applied the same. There's no different. There's nothing that's different. What may be different is what you're contributing, how much life insurance you're buying, how much leverage you have to be able to put. That might be different, but the strategy is applied the same across the board. So if I can't do it for you, there will be some other certified advisor that can. Only a certified advisor that understands this strategy and how it works can apply this strategy to your IUL. So again, I said, you told me not to answer any more questions that wasn't asked, but it kind of fit. So.
Okay. Well, you can work on that for next time. Okay. Peaky has a question. Well, did you answer the questions about what happens in 2025?
No, you guys won't let me.
Okay. Sorry about that, y'all. Let's get back into that.
So,
Come on.
Okay. And let's just replace 2025 with 2015 to help this example. So what happens when the market crashes and I owe 4%? So let's talk about it. You can take the question down.
Okay.
So in order to do that, like I said, I wanted to back up and create a brand new example. And that brand new example is saying, I've got 10,000 of my money and I'm borrowing 10,000 from the life insurance company, and both dollar amounts are in the bucket. So I put 10,000 of my money in the bucket, 10,000 I'm borrowing, leveraging from the life insurance company. So I've got $10,000 of my money working at 5%, and I got $10,000 of the life insurance companies working at 5%. Well, 5% of $10,000 is $500. That means someone way smarter than me is going to take this $500 and do what? They're going to take that $500 and go buy a one-time call option in the S&P 500 index. Anyone know what happened in 2015? The short of it is the market crashed. So what that means is this $500 that the actuaries had taken and to buy the one-time call option, we lost. So we did not make the $500 on my money, nor did the $500 on the leverage dollar amount go anywhere and do anything great because the market crashed. But the life insurance company could care less about the market crashing. The life insurance company comes back and says, hey, you borrowed $10,000 from me. And I know you were anticipating making 10%, and I was going to get my 4% out of the 10% that you were going to make, but you didn't. And you borrowed $10,000 from me, and I want my 4%. So let's do actual math. 4% of $10,000 is $400. So what that means is someone owes me, and that's what it says here. Someone owes me $400. Well, there's two things that are going to happen in order for the life insurance company to get the $400 that they're owed. And the person that owns this policy will not notice either one of them. So here's the first thing that happens. And we kind of have to compartmentalize a little bit. This $10,000 that I've contributed into this bucket, let's just say I'm purchasing. Remember, what are we purchasing in this vehicle? We're purchasing life insurance. So I purchased $255,000 in life insurance in this vehicle. The life insurance company says this, hey, we know you owe us $400 and we like compound interest. We like secure compound interest. We like making money. The last thing we want to do is impede your ability to make money. So what the life insurance company says is, hey, we are going to defer all interest payments until you die. So in this example, I put $10,000 into the bucket, borrowed $10,000. I have $10,000 working for me. We took that growth, bought the one-time call option, and the market crashed, which means I lost the $500 that I contributed, and I lost the $500 that I leveraged. So those are gone. But the life insurance company says, hey, I don't care. You still owe me my $400. The first thing that's going to happen is the life insurance company is going to defer that $400 until you pass. So let's run this all the way through. Let's say in 2015, you passed. Well, before your beneficiaries receive $250,000 plus your cash value, which is 20 grand. So 20 grand plus 255 is the total death benefit, the life insurance plus the cash value. Those are the $2 amounts that your beneficiaries would receive. Well, before they received, again, I'm sorry, this is incorrect. When you pass, you only get the money that you contributed to this policy. This $10,000 that you leverage is not yours. So let me back up. If you passed in 2015, the death benefit is the cash value, your cash value, which is $10,000, plus the life insurance a dollar amount that you purchased. So $10,000 plus the life insurance that you purchased. So $255,000 plus $10,000 is $265,000, which is what would be paid out to your beneficiaries. But before that $265,000 is paid out, the life insurance comes along and says, but we need our $400. So $265,000 minus $400 is what would be paid out in check form to your beneficiaries. As I mentioned when I first stated, if you are the one owning this policy, you won't know that happened because you are no longer here. So again, the first step is defer all interest payments till you die. So this $400 is getting deferred until you pass. If you don't pass, the life insurance company is keeping track of how much you owe them. Trust me, the life insurance company knows you owe them $400. Well, how does the life insurance company keep track of that $400? That's where this second item comes into play. It's simple accounting. It's called a ledger move. Again, You've put in 10,000, you borrowed 10,000, it didn't perform the way you wanted. Someone owes the life insurance company $400. The life insurance company is going to defer that $400 until you pass. Well, you didn't pass away in 2015. So how does the life insurance company keep track of the $400 that you owe? Well, they're going to make an accounting action, meaning they are going to compensate for that $400 by moving $400 from this side of the bucket to this side of the bucket. Notice what happened. Let's first step back and talk about the bucket. What is the bucket? The bucket is the general fund. What's in the bucket? My money is in the general fund. The life insurance company's money is in the general fund. Both dollar amounts are in the general fund. Is the general fund a dollar amount that I can access? Meaning, can I reach into the general fund and grab money out of it? I actually can't. So the general fund is owned by the life insurance company, protected by the life insurance company. And to keep track of how much money is owed to the life insurance company as a result of the market crashing, the life insurance company says, hey, we're going to move $400 of your money, which leaves $9,600. And we're going to add that $400 over to this side of the bucket, which leaves $10,400. So in 2015, when the market crashed, when the life insurance company moved $400 from my side of the bucket over to the dollar amount inside the bucket on the life insurance company side of the bucket, how much money did I originally have working for me in 2015? Well, I put in 10,000, I borrowed 10,000. 10,000 plus 10,000 is 20 grand working for me in 2015. Well, what happened at the end of 2015? At the end of 2015, I have $9,600 of my money plus 10,400 of the life insurance company's money. But as far as the total dollar amount working for me, what does that equate to? So from the time 2015 started to the time 2016 started, did I lose any money inside of my policy? From the time 2015 started to the time 2016 started, did the amount of money working for me change? Now, the market crashed. I owed somebody some money. I paid that dollar amount that I owed. How did I pay it? Because the life insurance company moved $400 from my side of the bucket to their side of the bucket. When that happened, I have now met my obligation. If the market crashed and I owed $400, the minute I paid that $400, I have now satisfied my obligation, which means that loan, that $10,000 that I borrowed, has just now become self-collateralized. This is a very important term. Self-collateralized is saying that I owe $10,000, and when I move that $400 from one side of the bucket to the other, that loan, that meaning the debt that I owed, has now been satisfied. Meaning the principal and interest that was owed, the principal is $10,000. Yeah, I owe it, but I don't have it, so they already have it. So it's not something that I have to give them. They already got it. But when I added the $400 from my side of the bucket to theirs, 10,000 plus 400, I have now satisfied my obligation that I had with the life insurance company. Why is that important? Well, that is important because in 2016, I now get to borrow that dollar amount again because I have satisfied my obligation, meaning this loan is self-collateralized, which means now I can borrow it again. So in 2016, I'm not starting from a place of I now still owe the life insurance company some money. I don't. So I get to start 2016 with a clean slate. And my 9,600 plus the 10,400 is still working for me in the general fund. I'm still going to contribute $800 a month. So blah, blah, blah. The performance of the continuous years continue to happen. So what happens in a down market? The life insurance company is going to defer all interest payments till you die. and they're going to do what's called a ledger move. They're going to move the amount of interest that you owe from your dollar amount over to their dollar amount inside the same bucket. But both dollar amounts added together means the money is still working for you. And what do I mean when I say the money's still working for you? Looking at these two dollar amounts. If we remember the performance says this 9,600 is on pace to make an additional 7%. And this dollar amount is on pace to also make an additional 7%. However, 4% of this is owed back to the life insurance company, which means in 2016, my money's going to make 7% on my money plus 3% on the life insurance company's money. Meaning, the reason this is important, the reason we have to do the ledger move and balance what's owed inside of this product is so that I can continue on getting the growth and building the compound interest inside of this product year after year after year. Now, the other question was, but what happens if in this scenario I was taking income, and I'm just going to make up a random number. Let's say I'm taking $1,000 a year in income. Again, I'm just making up a totally random number. If in 2015 I'm taking $1,000 in income, which is approximately 10% of what my cash value is making, meaning I've got 10,000 in cash value. 10%, that is 10%, right? 10% of $10,000 is $1,000. So I'm taking $1,000 in income. What does that mean when I'm taking income? That means I'm borrowing, leveraging 10% of this $10,000 as income every year. Well, in a year that the market crashed, in this scenario, I now have less than 100,000, but I still want to take my 10%, my $1,000 as income. How does that work? Well, in order to explain this and explain it, I'll call it with numbers, we'd have to go back to the calculator, but I'll just explain it in words for now. If I'm taking income, the dollar amount that I'm taking in income is very strategic. If I'm taking income 9 times out of 10, it's somewhere around 10% of my cash value. Again, just using an average. Well, if I'm taking 10% of my cash value as income, if you remember the buckets, show them to you real quick. If you remember these buckets.
How could we forget?
So if I'm taking income of, let's say, I'll go here. If I'm taking income of 10%, can we at least agree what I'm actually making inside this product is something more than 10%? If you average this dollar amount of the leveraged money that I'm using, it's somewhere in totality, it's somewhere around 13, 14, 15, 16, 17, maybe even up to 22%. So here's what I mean. If I'm taking 10% as income, but my cash value is making 13%, and again, this is a year where the market didn't crash. If I'm taking 10% of income and my cash value is making 13%, there's an additional 3% being left in my cash value that allows for my cash value to continue to grow year over year. Well, when I hit a year where it's a 0% year and I know I'm still taking my same 10% as income, well, because the prior years I was taking less than what I was actually making, mathematically, there's enough inside of my cash value to compensate for the year that I still take 10%. Now, that's if the market crashed in 1 year.
Okay.
What about if the market crashed 2 years in a row? What if the market crashed 3 years in a row? Like, this process is pretty powerful and can handle some consistent down markets. We've done the math, and I have the data which says this process can handle 5 to 6 consecutive down markets. So if it was one down market and I'm taking income, I'm not too concerned, because I can continue taking my income and the totality of, or the function of this process continues. Market crashes 2 years in a row, I can continue taking my 10%, not too concerned. Year 4, year 5, I need to start making an adjustment. Year 6, this process will implode. Well, When was the last time the market crashed 6 consecutive years? About never. What is the most consecutive down markets the market has had? It's been 3. That's the Great Depression. So what this is saying is this process can handle, at minimum, 2 consecutive down markets. 2 consecutive Great Depressions. Well, while it's not perfect, while you will still, at some point, your this product will implode, but at least it can handle 2 consecutive Great Depressions. Let's ask this same question of every other retirement vehicle you can put in front of me. How many down markets can your 401k handle? How many down markets can your 403b handle? How many down markets can a Roth IRA handle? How many down markets can real estate handle? How many down markets can Bitcoin handle? How many down markets can every other vehicle you have your money invested in handle compared to this? Show me one that can handle at least 2 down markets. So at a minimum, maybe MPI isn't perfect, but still, I have yet to find one vehicle that can outperform this process.
Okay.
Talk my earpiece out.
Wow. Well, I want to say thank you for all of those extra things that you add. We were in the chat talking about when you ask you a question, it's like getting 15 gifts with purchase.
And she just wishes that would happen when we have actual conversations.
I absolutely do. Thank you for that, you guys. Because I love it. We have a comment that's like, to Dan, that was a lot of information, and that's not the step that I'm at. They do have a question or a comment that I wanted to bring up later, but we do have a lot of questions I want to get into. Okay. I'm going to try to make this fast because I think I saw... No. I want to talk about the buckets real quick.
All right. Let me clean the buckets up there.
Okay. Here's what I wanted to say really quick. Anybody who understands, like, sourdough bread is a big, huge thing right now. And if this isn't for you, then just skip this part of the live, okay? If you know about sourdough bread, you have to have a starter. It's all about the starter, and you have to have this in order to make more sourdough bread. If you don't keep enough of the starter and you don't keep that going, whatever that gross stuff is, it's like sludge in the bottom, whatever that is, you have to have that. That's like the gold, right, of making sourdough bread. If you don't have that, you can't continue on. So sometimes people are like, hey, can you give me a starter? Because you can't just make it from scratch. It's not the best, right? It's like friendship bread. You give me a starter and then I can grow my own, right? And essentially what he's trying to show you is if you keep using all of the mix and you don't have a starter and you have to keep going out and restarting all the time, it's going to implode. Your process, you're going to fail, right? But if you have all of these starters starting, how many would you be able to make, and how much would those, it's a tiny amount that's in there, right? And eventually it grows its own and it continues to keep growing as long as you can manage that process. It just occurred to me that this is kind of saying the same thing. But instead of buckets, you're putting it in a jar. All right. How about that, guys? Okay. Let's pull up some more comments.
The more you know.
Yeah. The more you know. I had them all sectioned off here. Okay, let's go to the top.
Good, sweetheart.
All right. Okay, Piki has a comment. I'm going to save it for the end because it's a little off topic, but it's really good. Okay. Tom says, Donnell, is there a world where Skia works with whole life, dividend pay policy, infinite banking, and an annuity, or am I overthinking the benefits to get all the retirement income from overfunding Skia alone?
So, and I think the short answer to that question is yes, but there are so many layers here because here's the piece. Skia, secure compound interest account. An annuity is a Skia. An IUL is a Skia. A whole life policy can be a Skia. A 401k can be a Skia. And obviously MPI, maximum premium indexing, is a Skia. What does that mean? Like, what does that even just mean? It's all about the investment versus wealth equation, which I'd have to pull it up, but that's not for now. The difference between the investment and the wealth equation is this. The investment equation includes risk. Any vehicle you put your money in that involves risk impacts your ability to grow secure compound interest over time. As you are able to remove or reduce that risk, you transition from the investment equation to the wealth equation. A 401k can be moved from the investment equation to the wealth equation. How? You just have to get it from your employer. A self-directed 401k, you're able to put in a position to where you will not be impacted by market risk by getting it out of the market. So you have the ability. So a SKIA, there's so many things that fit in a SKIA. So is it possible to combine all of these features in a SKIA? That's actually what this product is. Why do I say that? A whole life policy is just a permanent life insurance policy. That's all it is. Don't get it twisted. A whole life policy is not special. An IUL, an index universal life insurance policy, is just a permanent life insurance policy. It's not special. It's the structure that makes it different. And then when you apply the right structure and the right application, so here's what I mean. You properly design a max funded option B IUL with leverage. Can you do infinite banking all day long? Matter of fact, you can do it better than you can inside of a whole life policy. Why?
That part.
It's the structure. Show me the whole life policy where you're making X percent and it costs you Y percent to leverage it. And that's a positive interaction. What do I mean? Show me the whole life policy that says you're making 4% guaranteed. And the cost to use that money that is made inside that whole life policy costs less than the guaranteed dollar amount you're making. Doesn't exist. So again, what do I mean? Inside of a whole life policy, you're making guaranteed 4%. To use your money, to leverage your money, to borrow your money, to take a participating loan out of the whole life policy to do infinite banking, it costs you at minimum 5%. So if I'm making 4%, but it costs me 5% to use my money, I'm making negative 1% every time I touch my money. If you were going to bank on yourself and you were starting a bank today, and the guys that said, hey, I'm going to invest in you being able to bank on yourself today, but you told them you're going to lose negative 1% every time you use your money, who wants that bank? But the way this is, I'll call it advertised to you, is you're supposed to be okay with making 4% and it costs you 5%. Let's take the same concept over to a properly designed maximum premium indexing strategy or premium finance strategy. Let's take that same design, meaning you're making not a guaranteed 4%. You're making on average 7%. The data says on average 6.87% to be specific. So on average, you're making around 7% inside this vehicle. To leverage your money, the cost of borrowing your money, the cost of the participating loan, the cost of using the dollars in the policy to be able to leverage and go do infinite banking is 4%. I'm making on average 7. It costs me 4. The minute I touch my money and go use it, my money is still making me 3%. So if you're going to create a bank, if someone said, hey, let's go create our own bank. And I said, hey, when we create this bank, whenever you use your money, you're going to be still making 3% inside your bank. Isn't that the definition of a bank? Banks don't create money. They create arbitrage. They create positive arbitrage. There's not a bank who's still in business who's creating an arbitrage position that's negative. But every time you create a whole life bank on yourself policy, you are creating a negative arbitrage position. It does not make any sense. It doesn't logically make sense.
And it wasn't designed for that. The life insurance never agreed for it to be used like that. it was just a strategy. People said, oh, technically we could use it like this, but now they're cracking down because they see that people are abusing this situation and getting themselves in trouble doing this. So in order for them to uphold the integrity of their product, they're seeing that now this has become problematic because people are using the term infinite banking as if the life insurance companies are on board, and they never were. The difference is with this strategy, it was designed to be leveraged. That is completely different, right?
100%.
Okay, this just in, we need to move on to the next question. Okay, all right. Thanks, Tom. It's a great question. Lolo says, the cost to borrow 4%, is it fixed or is it based on whether the Fed raises or lowers interest rates? Great question.
You're not going to hear this from anyone. I don't care if you talk to Curtis Ray himself. You are not going to hear this from anyone else, probably other than me. And that is this. Rates continuing to rise is actually a positive in a vehicle like this. Like, why would I say that? So is that 4% fixed? It is not. It is based off rates today. That 4% has been 4% since I've been involved with this product. So it has not gone anywhere. There's a ceiling though, meaning it's not fixed. So it can rise, but there is a ceiling. That ceiling is 6%. So let me walk you through a scenario. Let's say there's a situation where inflation is so outrageous, eggs are $133 for a dozen of eggs. Inflation is so high, interest rates are so high that interest rates in everything are starting to rise. Well, the ceiling on the participating loan inside of this vehicle, the ceiling is 6%. And as interest rates start to rise, that means that that cap on the call option will move as well, which means it's not 10%, it might be 12, it might be 13, it might be 14. Well, imagine this scenario where the cap on the call option is 15%, but the ceiling on the participating loan is 6, which means your arbitrage, your spread on what you can make inside this policy just went from somewhere between 3 to 6% to something more like 6 to 12%. Like this is a scenario that would actually work in your favor in a product like this. Now, the economy would collapse, like everything else would be horrible. But my point is to answer your question, is this 4% fixed? It's not, but there is a ceiling. And it actually, if we are in a position where this ceiling is being encroached upon, it actually works positively in your favor in a product like this.
All right. Zaid, by the way, thank you so much for this super chat. We really appreciate it. And we're going to play this sound to prove that. We really appreciate it. We've heard so many people, and you're not able to pay attention to the chat, but I'm in here cutting it up with them. Mm-hmm. And what we're talking about is the value that they get and how who's watching replays and where at different stages in the game, and just the amount of value and remembering times when you didn't even want to be on video or do this at all, right? You're very timid and more of a introvert in terms of getting out there and sharing this information. And now that looks completely different. And really, I don't think we would be able to do that if it wasn't for our community. Right. And the people, and watching how many lives are being changed by this information. Even today, just the fact that you came around the corner and you were like, we are changing lives. Like the stories that you hear and the results that you get to see every single day from the people that we connect with, and watching these things happen in real time is like fuel, right? It's not just exciting. It's also humbling, but it is.
It makes it fun to get up in the morning.
Yeah, really I don't even know the word. It's really just, it's rewarding. Yeah, it's rewarding, but we're honored too. And I realize that we have to serve in the way that we know is best, right? So these answers can't be faster than maybe they could be.
Boom!
Just a little bit.
Rip shot.
It's possible that they could be or not, but we're just going to keep going on. Thank you, Zaid, for showing your gratitude, because this is, whether if it's reviews on our, Google My Business page or Facebook page, those types of things, right here in the chat. Nobody else gets to see them unless they see the chat. So these kinds of moments are great for us to show other people that other people are getting the value, because we see it all the time. But if we don't do a better job of sharing it with other people, then they don't know who we are, right? They don't know what people are in here doing. Okay, so thank you. All right, so moving right on. Moving on. Okay. Piki says, you want to grow and blow up, figure out how to approach the serious crypto community. These are people who are looking to secure their future and know nothing about this. And then that's what led me here.
So I have a pretty diverse clientele, and there's a couple things as it relates to the crypto community. What I've been trying to educate those who I do come in contact with in this community is this: there are two ways to approach this. Because how about this? The problem with crypto is they are looking to heavily tax you. Well, again, this is off topic. If you were to shift to a self-directed 401k perspective and actually build your crypto portfolio inside of a self-directed 401k and use Roth dollars to do it, regardless of what happens with, because I'm telling you, they are working on trying to tax you heavily in this space. But what I've been trying to help my clients understand is how to shift from being in a taxable position to moving to a non-tax position and using your self-directed retirement account to actually buy your crypto. And so whether you're buying a tax deferred or tax free, I would prefer a tax-free position. You get to do whatever you would like. But my point is, you're absolutely correct on this community. And as it relates to day traders, crypto, my take on that is any of you in these spaces should be skimming off the top, meaning you've got a vehicle that is growing great for you. Awesome. All it takes is someone to sneeze in that market for things to go really bad. So while things are going good, skim off the top. And what that means is take 10%, dump it into a secure compound interest producing vehicle. So if you're a day trader, take 10%, dump it into a secure compound interest producing vehicle. Get your money working for you. And so what happens is you create a system. So not only are you making money in these vehicles, but those vehicles are also feeding another system that may even be able to replace the original vehicle if it builds up enough compound interest. So you're absolutely correct. Now, as far as how to reach out to the crypto community, I run into a lot of these spaces in these real estate environments that I'm in, mainly because a lot of the people with crypto dollars are trying to figure out what other vehicles they can invest in to hold on to the crypto that they have. And that's kind of where we kind of cross paths. But you are absolutely correct, though.
Yeah. Okay, so not only will you owe the interest, but you will also owe the 10K loan for that year. And then if it is still zero next year, you will pull your 10K, assuming you have the cash value to do it.
That is true. But let's kind of play that out a little bit. Let's say a non market crashing year, that 10,000 that you leveraged, that you borrowed the 10,000, use it as income. But let's say on average, you made 13%. So even though you borrowed 10,000, because you made 13%, you borrowed 10%, you made 13%, there's nothing to owe because you made more than you borrowed, you made more than you leveraged. So it canceled itself out, meaning you leveraged 10, you made 3. You leveraged 10, you made 13. And so that it equates to your account growing an additional 3%. But you're right. In a down year, not only did you do the ledger move and move 4% over to the right side of the column, or whatever that 4% of whatever that dollar amount is, but you also leveraged 10,000, which means that 10,000 that you leveraged also moved over as a ledger move, meaning it's not now you owe an additional 10,000. It means an additional 10,000 or whatever that income is, that additional dollar amount was moved over to the right side of the bucket. So it's another ledger move. So not only did 4% move over there, that $10,000, not only did the $400 move over there, that 10,000 that you're referencing also moved over to the right side of the bucket. So right, your total cash, your personal cash value dropped, but the total accumulation value still did not change, even though you took income as well. And if the market crashed again, that's just another ledger move. And so if it's another ledger move, the total accumulation value of the dollar amount working for you still did not change. Go ahead, sweetheart.
Okay, Zaid had a very similar question and then a follow-up question. So I'm just going to skip to his follow-up question. Do each of those distributions get counted as loans against the death benefit total if not paid back?
If you ever hear otherwise, run. If you ever hear anyone who provides life insurance in any form say withdraw, run. Every dollar amount you get out of a cash value life insurance policy should be a leveraged dollar amount, should be a borrowed dollar amount, should be a participating loan. Why? That is how you maintain your tax advantages inside of this product. So any dollar going into your pocket going anywhere, you're doing infinite banking, you're doing reverse velocity banking, I don't care what you're doing. Any dollar amount you take out of any cash value life insurance policy has to be leveraged dollars so you don't lose your tax advantage position with this product. So,
Okay, we have a situation going down in the chat. I'm gonna try to find it.
I've got a situation going down in my stomach.
Okay, well, we will try to move this along. Tadam says it's harder when you own your own business. Now they are S corps, but we are going to have to leverage debt in the next few years. Now they've got rental properties, they've got a whole bunch of stuff going on. Love getting up in the morning now and being self-motivated with our own business and saying that it's scary going from 9 to 5 to owning your own business. And that's really like the responsibility around becoming self-directed because it's you, right? You're the one propelling the machine forward. Now you can leverage different machines, but you're the one connecting it all together now. And you got to learn how to do it. And it is very scary. So we hear you about that. And so we got a special request to give Mikey B. Adams a shout out, loud and proud. We know what it's like to be doing this and be on the side of this. And it does. Being encouraged is so important. And if you're doing this with your partner too, on top of that, it can feel extremely vulnerable. Not only the brave go in doing it together. And it is learning this person in a whole different way. And sometimes it does require, we would have loved to have somebody cheering for us in moments. Wouldn't you agree?
Did you guys hear the subliminal in there? Because we're speaking from experience.
And we're still together.
So here's the thing. We put up this, and we haven't done it in a while, but we put up this picture of these strategies that we talk about. And it has a little combination lock in it. And what you are speaking to Tadams, what you're speaking to is the approach that we had actually taken. Because, and again, all of these vehicles go together. We use the velocity banking to eliminate debt, to free up cash flow, to help us understand how to use debt tools.
Right.
Then we converted our mortgage to a home equity line of credit, which is just a debt tool, to do what? Use that debt tool to free up leverageable dollars to do what? Well, we realized that if we didn't do something different, if we didn't make a change, we were going to be working for someone for the rest of our life and not have enough to retire. So we had to leave that corporate America nonsense, I almost said another word, nonsense alone, and take this leap, this scary leap into entrepreneurship. And in addition, because we left corporate America, they gave us access to what? Our previous employer's plans, which allowed us to do what? Leverage some of those dollars out of my self-directed 401k to be able to do velocity banking, to be able to put ourselves in a position to have a HELOC, to understand and learn about infinite banking. And in the midst of infinite banking, realizing there's actually a better vehicle out here compared to a whole life policy, that if you actually take the same concept and apply it to a properly designed, properly structured IUL, all of these can feed themselves and all work together to do what? Generate income and generate wealth. So you are 100% spot on. The path that you are walking down is lonely as hell. And so in addition, like understanding how these vehicles work and how they work specifically in your life, because what we talk about is there's many ways to 10.
Right.
What we're walking you through is what we've done. Yours may look different. But hopefully what you can take away from this is there are other vehicles out there that maybe you weren't aware of. And there are other vehicles out there that, you know what, if you structure them properly and you put them in the right position, they can actually work together and feed one another. And in doing so, you can actually, it can help you hit your goal. But here's what we cannot do. And here's this, because this is what entrepreneurs do. And just so we're clear, if you were looking at me and my wife, there's really only one entrepreneur on the screen. I'll call it someone who is learning how to become. But here's what I know about entrepreneurs. There's no such thing as 9 to 5. There's no such thing as Monday through Friday. And so it is using all of the moments you have at your disposal to focus on what? Not just building your business. The concept of the wealth equation starts with pay yourself first. The problem with entrepreneurs is we don't understand what pay yourself first means.
Right.
We think pay your business first.
Right.
Is what entrepreneurship is.
Pay your bills first.
The way you generate wealth is you pay yourself first. The first thing you need to do is you take a piece of that pie. That pie is 100%. You have to take a sliver of that pie. Let's call it 10%. And you take that 10% and you put it in a vehicle that can start generating income for you. And then you pay bills from there. And I get it. I know the entrepreneurial life, that sounds very easy to say that I can take of my 100% that I need. Maybe I need 100% of it to go to my business. Well, that's where the velocity banking comes into play. That's where these other actions come into play to help you generate and accumulate cash flow. And as that cash flow is accumulated, you go back to the original thought. If I'm going to generate wealth, it starts with pay myself first. Today, somewhere securely, compound my money. And then as my money is compounded, I use leverage to help grow my money exponentially. That's the equation. Pay yourself first, starting today, somewhere secure, compound your money, and then you get that money compounding using OPM, other people's money. You can put your money in a position to do that, it's game over. Because once that system starts feeding itself, there's nothing, it's a snowball rolling down a mountain. It becomes so large that it can't be stopped.
Yeah, that part. And really what you're doing is you're generating a machine aside on the side of your business that right now you're trading your time for money. It's not, right? It's learning to walk and crawl and walk and run all on its own. And it just takes time in order to do that. But you just have to keep feeding it. This moment that you stop feeding it, it starts its decline. But you just, no different than a pet. I don't know. Let's move on from the analogies. I don't have a good one for that, but you just have to keep feeding it and it will continue to grow. But a lot of times business owners, especially people who have like service and trade-based businesses, because they are literally trading their time for money and they always have to have a new client. So there's not really an opportunity to have, like a retainer or a recurring business every single month, right? And there's no like subscription based or whatnot. So the structure of the business and the payments inside the business makes that difficult. Oftentimes we're married to these ideas because this is like what our trade is, or this is what we had spent our whole career in are these skills, and this is what we want to be able to use. But it doesn't mean that it necessarily serves us, or it may not mean that we have to do it in this way. So sometimes we just need to get with a business coach and they can maybe see some things, the forest through the trees, so to speak, that can help us understand how we can scale our income or how we can structure our business in a different way that would open up more opportunities for income. Because to your point, Donnell, it's easy to say pay yourself first, but if you can't even pay the bills, it's hard to wrap your head around or adhere to that concept. Oftentimes, the whole point of being an entrepreneur or owning your own business is so that you have time freedom. A lot of people think that at the end of their career, I'm going to start my business. It's going to start as some side income or whatnot, and then eventually it'll turn into my full income. That's the plan, so that I can stop working. But you just trade your 9 to 5 in for a 24/7, and now you hate it because you don't actually have time freedom. You think you have time freedom until you realize that the time that you took off was actually costing you far more than the weekends that you were getting off with your old job, right? And there's no paid vacation days or sick days. So that's the part. And to your point about becoming an entrepreneur, I think there's phases and stages to this, depending on where you are. And support really does matter because it's hard out here for everybody. it's hard, especially if you didn't go to school for how to build a business, right? For business, it's very difficult to understand how to wear all of those hats. Even people who go to school for business are not trained in how to wear all of the hats.
Right.
They're just not. But we do as solopreneurs, right? We have to learn how to wear all the hats. Even if we've hired people to do those roles, we still have to understand how do we know that they're fulfilling that role, right? We still have to learn a lot. So community matters, and reaching out and having help, those things matter. So we have a community inside of our Facebook group. We're trying to become more active. Next week we'll be in Indianapolis, and we meant to try to start, but I don't think we had anybody that said that they were in the Indianapolis area, right? Yeah, so we couldn't do a meetup there, but I think the Orlando one this summer we're gonna do something, right? People are there. Yeah, if you're in Indiana and you want to do a meetup, maybe we can work it out. Maybe we can't. Don't know. Okay, but we're at 2.5 hours now, and I know we got to go. We still do have a couple of questions left, though, that I had already flagged. Is that okay? Can you do rapid fire?
We'll see.
Could you? Okay. All right. Oh, no, this is no. This is him asking her a question, not me. Okay, wait. No, okay. She was asking, I need an FSA. I got the gold on the self-directed 401k. My goal is to fund the 401k and the FSA this year 3 today. I will be able to get my commercial real estate building with my SD 401k. Yes. Okay.
All facts.
I have a mortgage on the second home. Is a fixer upper. Can I get that debt gone faster, or do I refi?
So,
I think they are near to.
Yeah, and it depends. The question is, how much equity do you have? And if there's equity available, can you leverage some of that equity to get rid of the debt faster? And the short answer to that question is yes. And as Angelique, as you mentioned, we'll be focusing on some of those actions like leveraging your home equity line of credit to pay off the mortgage faster if that's something that you choose to do. Meaning there's a recast option that we talk about that we haven't talked about in a while, that if the objective and or the goal is to be able to reduce the mortgage for whatever the reason, there's a strategy associated with that where you can use a home equity line of credit to be able to do so. And really, it all kind of depends on where your cash flow is. But yeah, we can absolutely talk through that.
Okay, Piggy had a good question. I'm actually going to screenshot it because I want to. This was actually answered in our Wizard of Oz series. I'm going to bring it up, and we're going to do a cliffhanger. Even though it doesn't tie into reverse velocity banking, we're going to answer this the next time for sure in a little bit more depth. Are the bonds mainly treasuries, or do they diversify across other municipalities? Watching the converting BRICS nations potentially dump treasuries, are we looking at potential holes in our buckets? I think it's a great question, and it's definitely something to consider, especially with all of the talk about the looming recession or Great Depression that a lot of people are saying are upon us, in addition to how our banking systems might change, right?
Right.
Oh, go ahead.
No, go ahead.
When we did the Wizard of Oz, it was so ironic that right as we started to put this together in terms of like the history of retirement plans and how well it fits up with all the characters and how they are introduced inside of the film and how they line up with, it's literally our story. We were shown it decades ago. This entire story, it's crazy how it lines up. So go watch that if you haven't seen it. We also talk about bricks. Because what is she walking on, right? What is she following? The yellow brick road. And it's been here this whole time. That where does it lead to? It leads to the Emerald City. And if you saw that series, and you would understand what an Emerald City Syndrome is too. Emerald City Syndrome had nothing to do with where the answers were. Emerald City had nothing to do with where solutions were found either. It was just simply where everybody went to feel better about the decisions that they were making. They didn't need any of it, right? But that's where the bricks led to. And that's what she was told by somebody who put the slippers on her, right? They knew Glinda, who is not a good witch. We have taken her off of that list now. We're not going to get into it right now, right? We're going to sum this up quickly. Lightning round. And we're going to just say that, yes, looking at how these things are structured and how they might change really is important. I do feel that anytime getting educated is not a bad thing. Here's what I'll say though. If you understand how it's structured, then you have to look at who would benefit. Who would benefit from those structures changing in the ways that you just suggested? And where would the holes in their buckets be if they put holes in the buckets that we're leveraging? Because these buckets are so highly leveraged and utilized at the top tier, the S&P 500, securities and bonds, right? Because these are not, these aren't toys in the market. This is significant.
It's infrastructure.
Yeah, for sure. It's framework.
And here's my take, because I get asked this question a lot. Well, that's not the question that I get. I get asked the question around, what do you do?
Yeah.
Like, the world is coming to an end. What do you do?
Okay, here's what you do. You tune in on Sunday because we're going to talk about how to flip it and reverse it and take everything that we're learning and how to apply it in a different way and win and build two machines at one time. That's what we're going to do. And we're going to show you how to use leverage in a completely different way so that not only are you not having to wait for your machine to grow and start producing income, you can learn how this machine is going and leverage this machine to start another one on top of that. And we're going to talk about how to do reverse velocity banking and how to use the same concept of cash flow we're going to use the same concept of using cash flow sitting on a debt tool, where we're going to take that cash flow and that leverage and we're going to put it on a wealth tool. And that's what we're going to get into on Sunday. I am very hungry and getting tired and losing my words. Should we spin for a boat?
No.
Or we will save it. We'll just spin for extra ones. Okay, come back next time and we'll spin earlier too. We're going to spin for them there. All right. So that's what we're going to do. You said your tummy, so let's wrap it up. Okay, we like to end with, and thank you guys so much, by the way, for tuning in and staying in here with us, because we enjoy this time with you and we appreciate your time. We know that time is the most valuable asset that we have, and we appreciate you spending your time with us.
Absolutely.
So on that note, we like to end with, if you didn't come from a wealthy family,
you can make sure a wealthy family comes from you.
So stay tuned.
Stay protected.
Stay focused.
Stay connected.
I'm Angelique.
And I'm Donnell.
And our goal is to help you
get self-directed.
And to do that, we have all these free resources. So don't sleep on those. And we'll see you back here on Sunday to reverse it, to flip it, and reverse it. We'll see you guys then. Thank you so much for tuning in. Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get self-directed.